Hello champions, I hope you are doing really well. Now this video is really important for you if you're writing the May 26 exams, alright. So for your May 26 exam, of course, your May 26 RTP, MTP 1 and MTP 2 will be non-negotiable, right guys. Now what I did is, I did something that's going to make your work a little easier. So in these three resources, I went through these three resources and I identified 10 must-do questions. So basically the remaining questions, apart from these 10, the remaining questions were either familiar questions, questions which we've seen in the past, nothing new, or they were questions which were very simple. So I ignored those questions and I found 10 really important questions which had some very good adjustments. Like 80 AA is covered over here, a little bit of 44 AB is covered over here, there are some total income questions over here, there are some case-based MCQs over here. It's a nice mixture of questions, okay? So these 10 questions are like your must-do questions before your examination. The remaining questions, if you have the time, you do them. If you don't have the time, you don't do them. It's not a problem. But these 10 are your must-do questions which I've solved for you in this video quickly. I had done this video live for the Ernakulam Sikasa. That same video I'm attaching right after this intro and you can start watching. Starting with question number 1. Question number 1 is your May 26 RTP question, alright. Let's read the question carefully first. It's a case-based MCQ. So the question says, Mr. Roshan, aged 45 years, he is employed as a finance manager in XYZ Limited. He is 45 years. So at this stage, you will conclude that Mr. Roshan, you are not a senior citizen. Okay. So he is working where? In XYZ Limited. In Mumbai, he is working. During 25-26, he receives the following: salary, DA, all this is given to us. He owns a house property which is let out. About the house, they have given us information. Then what else? A lot of other information and all they are giving. What are they asking? Mr. Roshan wants to pay tax under default regime. So guys, all my computation will be as per which regime? All my computation will be as per section 115 BAC, right? The question is saying very clearly that he wants to pay tax under the default regime. So all my computation will be as per 115 BAC. Now what are they asking? What would be the amount chargeable to tax under the head salaries? So salaries, taxable salary they want. Then they want to know the taxable capital gains, total income they need to know. And they also want total income if he opts out of the default regime. Opts out means what? Opts out means normal regime. So are you understanding what exactly they're asking in the MCQ? So first all the computation as per default regime. Then we have to redo it as per normal regime. Okay, come on guys, let's begin. Let's get to work. As we read the question, let's keep doing our working notes. So first of all, he receives the following: basic salary. Basic salary means salaries head. So under salaries head, he is receiving basic salary how much? 60,000 per month. 60,000 into 12, 7,20,000. Then he's getting DA 12,000 per month. So DA 12,000 per month. That's going to be 1,44,000. Please keep in mind 50% is forming part. Okay. Then comes employer's contribution to PF, 15% of salary. So employer's contribution, I'll do a working note. Let's say working note number 1. So I'll open working note number 1, employer's contribution to RPF. Now how do you start with employer's contribution to RPF? First of all, you will compute salary for the purpose of RPF. Salary for the purpose of RPF will have how many components? 3 components guys. Basic salary, DA forming part, and employees turnover based commission. So what's our basic salary? We just now calculated. Basic salary is 7,20,000. And what is DA forming part? See, 1,44,000 is total DA, but I want DA forming part. Out of DA, how much is forming part? Only 50% is forming part. So 1,44,000 into 50%. My DA forming part is going to be 72,000. Okay, then after this, any turnover based commission? We don't have any turnover based commission. So salary for the purpose of RPF is going to be 7,92,000. Alright guys, then tell me, what is the actual employer's contribution? How much did the employer actually contribute? What's the actual employer's contribution? Employer's contribution is 15% of basic salary. Read the question carefully. It says 15% of basic salary. So what's your basic salary? 7,20,000. 15% of that, that's going to be how much? That's going to be 1,08,000 guys. That is the actual employer's contribution. But can you please tell me how much is going to be exempt? What's a percentage? How much contribution is going to be exempt? 12%. 12% of what? 12% of the salary which I calculated over here. So 12% of 7,92,000, which is going to be 95,040. This is going to be exempt. So with this, can I find out what is my taxable employer's contribution? Easy, no. I received how much? I received minus exempt will be taxable. So I received 1,08,000, out of which 95,040 will be exempt. So the balance 12,960, this will become our taxable employer's contribution, guys. Alright, so my employer's contribution to RPF, I first computed salary. Salary will have three components: basic, DA forming part, and employees turnover based commission. Then after that, I saw what is the actual employer's contribution. The actual contribution was 15% of basic. So I took only basic and I did 15% of that. Then how much is going to be exempt? 12% of the salary which you computed, received minus exempt, balance is taxable. Okay, now at this stage, let me remind you, there is one more provision, okay, with respect to employer's contribution to RPF. That one more concept is very simple. We have to see how much is employer's contribution to RPF plus superannuation fund plus NPS put together. Okay, if this contribution happens to be more than how much? Does anybody know? There's a number over here. If employer's contribution to RPF, superannuation fund and NPS put together, if it is more than 7,50,000, then in that case, what do? You find the excess, guys. The excess will be taxable as perquisite. Then on this excess, I will find what is the interest. That interest also will be taxable as perquisite. But here tell me, in this question, is it more than 7,50,000? In this question, employer's contribution is only 1,08,000, guys. Is it more than 7,50,000? It is not more than 7,50,000. Therefore, in this question, all this drama will not come into the picture. So in this question, what is my taxable employer's contribution? 12,960. I'll take it to my main answer. Easy. This was pretty simple. With this, our first para is done. Now come to the next para. The next para is IFHP head, guys. He owns a house property which is let out, guys, let out property. And by the way, I hope you haven't forgotten, we are doing the whole computation under which regime? We read the question. Question is saying we are following default regime. So we are doing the whole computation right now as per the default regime. Okay. So then the question says he owns a house. It's a let out house. He had taken a loan for acquisition of this house and he paid interest of 2,20,000 during the year. So it says he is having a house, a let out house. For that house, interest of 2,20,000 we are having. Details they have given to us: municipal value, fair rent, standard rent, actual rent, municipal tax, repair expenses. Guys, with all this information, don't you think it is easily possible for me to compute IFHP? Yes, so let's begin. But before we compute IFHP, let's close salaries. So what's your gross salary at this stage? Gross salary 8,76,960 I'm getting. Minus section 16 deductions, tell me correctly. Assessee is following default regime. In default regime, how much standard deduction do you get? You get 75,000 standard deduction. Very good. So what's your net number? Your net number is going to be 8,01,960 and this is going to be your taxable salary as per default regime. This is done. Now come on, let's start our IFHP computation. So in IFHP, what kind of a property is it? It's a let out property. Guys, I have a question for you. What if this was a self-occupied property? In 115 BAC, if this was a self-occupied property, will you sit and do any hard work? No. If it is 115 BAC, had it been self-occupied property, answer itself would be 0. Right, guys? No interest. Nothing is allowed for self-occupied property in 115 BAC. So, had your assessee been following the default regime, I wouldn't have done any calculation. I would have straight away said IFHP is 0. But over here, that I can't use that shortcut because it is let out property. So, full computation we have to do. Come on, guys. Let out property, how do you start? You start with gross annual value. Gross annual value. Come on, let's check how many months does your assessee own the property for. Does the question say assessee bought the property in between the year or sold the property in between the year? No, guys. So we will do computation for all 12 months. We will do the computation. So how do you start GAV? Tell me now. GAV step 1. Step 1 is going to be municipal value or fair rent, whichever is higher. What's your municipal value? 1,80,000. Be careful, guys. They have given us per annum number already. Okay. So 1,80,000 municipal value. And what is fair rent? 1,95,000. Out of these two numbers, which number will I pick? Whichever is higher. Which is higher over here? 1,95,000. Then what's your step 2? Your step 2 will be your step 1 number or standard rent. Your step 1 number is 1,95,000. And what standard rent? See, given in the question, 1,80,000, which is lesser. Clearly 1,80,000 is lesser. Then comes your step 3. Step 3 will be actual rent minus unrealized rent. Actual rent, nothing we have to calculate, guys. All the information is spoon fed to us in the question. Actual rent is 1,70,000. No unrealized rent. So full 1,70,000 as it is I will take over here. Then comes my step 4. Step 4 will be your step 2 number or your step 3 number. What's your step 2 number? 1,80,000. Step 3 number 1,70,000. Out of these two numbers, which number do you pick? Step 2 or step 3, whichever is higher. So which is higher over here? 1,80,000. Then do you have any vacancy loss? Does the question say that property is vacant for a certain number of months or anything of that sort? No vacancy loss, nothing, guys. So that's it. So what's my GAV now? GAV will be step 4 minus step 5. That's going to be 1,80,000. Okay. So my usual GAV computation I did. So with this I have the GAV number. My GAV is 1,80,000. Now from this, what do we subtract? Come on, guys. Typical let out property calculation. We will subtract municipal tax paid. But municipal tax has to be paid by whom? Municipal tax has to be paid by the assessee. But over here, see who is paying the municipal tax. Here, municipal tax is paid by tenant, guys. So will you allow that municipal tax which is paid by tenant? You will not allow. So what's your NAV now? 1,80,000 as it is will become NAV. Then from this you will subtract deductions under section 24. First deduction will be standard deduction. What percentage? 30%. So 30% of your NAV number. How much will that work out to? That's working out to 54,000 rupees. And then you will subtract interest on borrowed capital. How much is the interest, guys? 2,20,000. But oh, I have to restrict it. No, I have to restrict it to how much? 2 lakhs? No, we restrict interest only in self-occupied property. This is let-out property. In let-out property, there is no limit on the interest. So whatever is the interest, fully I will allow the interest. So what's my net number? We did not have any pre-construction interest in the question. So 94,000, negative 94,000, this will become your loss from house property. Okay, so we are doing a case-based MCQ calculation. So we have taxable salary 8,01,960. From IFHP we are having a loss of 94,000. Okay, this is also done. Now are you ready for the next set of information? Come on, buckle up, sit up straight, no slouching, focus. Other transactions during the year. Let's see if you can give me correct answer over here. Household LED, refrigerator, purchased in Jan 2017, were sold in Feb 26 for 15,000. What to do? Capital gains? No. See, I'll help you, okay? It's very simple. Assessee is selling something. So therefore, which head of income will you think? If assessee buys a capital asset, you will think about IFOS head. When assessee sells a capital asset, you will think about capital gains. So because assessee is selling something, I will first of all think about capital gains. But you know very well, capital gains comes into the picture only if I'm selling a capital asset. But you tell me, is household LED and refrigerator, are they capital assets, guys? No, they are going to be personal effects. Personal effects means what? They are movable assets and I use them for personal purposes. So they become personal effects, and personal effects will not be capital assets. So because they are not capital assets, will there be any capital gains calculation? No capital gains calculation. So unnecessary, useless information. Now come to the next discussion, guys. Advance of 4 lakh rupees was received from Mr. Vanraj on 1st May 25 against sale of urban agricultural land for 11 lakh rupees, which was being used by his father for agricultural purposes, blah blah blah. Tell me, advance money forfeited, where will this go? Advance money forfeited, any date comes to your mind? 1st April 2014. If advance money is forfeited before 1st April 2014, what will you do? You will reduce it from cost of acquisition. But if advance money is forfeited on or after 1st April 2014, then you will straight away tax it in IFOS head, guys. This advance money is forfeited when? See, it is forfeited on 1st May 25. It is forfeited on or after 1st April 2014. Therefore, this advance money forfeited will straight away be taxed for you under IFOS head. So, I'll open my IFOS head over here. I have advance money forfeited. What is the amount? 4 lakh rupees. I am straight away taxing it under IFOS head. Okay, it is forfeited on or after 1st April 2014. So the entire amount will as it is be taxed under IFOS head. Now come on guys, continue reading the question. This advance money forfeited is relating to what? It is relating to an urban agricultural land. This urban agricultural land was being used by his father for agricultural purposes during last 2 years. Okay, some information they are giving. So this information is about what? Urban agricultural land. They are saying 2 years this land was being used by father for agricultural purposes. Okay. However, due to non-payment of balance amount, advance was forfeited. Yes, advance money forfeited. We already taxed it under IFOS head. Then the question says, the same land was subsequently sold to Mr. Jain. Now what to do? That same urban agricultural land, we're talking about urban agricultural land, that land is being sold. Which head of income will come into the picture? Capital gains head of income will come into the picture. So assessee sold that land to Mr. Jain. Sold when? On 1st December 25. So 1st December 25 will become your date of transfer. Sold for 10,50,000. This will become your full value consideration. Land was purchased on 20th Jan 2006. This will become your date of acquisition. It was purchased for 1,50,000. This will become your cost of acquisition. Then Mr. Roshan purchased a new rural agricultural land on 10th March 2026 for 9,50,000. Come on guys, capital gains adjustment they want us to do. Are you ready? Can we start? Come on, let's start from basics. What is a capital asset transferred over here? What is my assessee selling? He's selling an urban agricultural land. By the way, is urban agricultural land a capital asset? Yes. What is not a capital asset? Had it been rural agricultural land, you would have screamed that, ma'am, it is not a capital asset. But this is urban agricultural land. Assessee is selling a capital asset, urban agricultural land. Therefore, there will be capital gains. So, capital asset transferred is urban agricultural land. Then what's the period of holding? When did we buy the land? See, we bought the land on 20 Jan 2006. When are we selling the land? We are selling the land on 1st December 2025. Tell me guys, is the date of transfer before amendment or after amendment? Date of transfer is on or after 23rd July 24. So is this, what's the relevant period of holding by the way? Immovable property. What will your relevant period of holding be? It should be more than 24 months. So yes, this is more than 24 months. Period of holding is more than 24 months. So what will you call this asset? You will call this asset as long-term capital asset. If long-term capital asset, will 112A apply here? Is it listed equity shares, listed units of equity-oriented mutual fund? No, right? So therefore, which section will apply over here? 112 LTCG this is. Okay. Now come on, let's start with our computation of capital gains. What's your full value consideration? For how much we sold the asset? See, we sold for 10,50,000. Then we read the whole adjustment. Did we have any expense on transfer? We didn't have any expense on transfer. So this itself becomes net consideration. Then tell me cost of acquisition. Can I index the cost of acquisition? No, only if I transferred the asset before amendment, then only I can index the cost of acquisition. Now some of you will say, ma'am, 12.5% without indexation, 20% with indexation, whichever is lesser, all that we have to do. All that we do only when we compute tax. Are we computing tax right now? No, we are computing only income, right? So right now, no drama, straight away, normal, usual calculation. My cost of acquisition is how much? Cost of acquisition is 1,50,000 over here. I am not indexing the cost of acquisition because my date of acquisition is not before the amendment. My date of acquisition is after the amendment. After the amendment, no indexation, no cost of improvement, nothing. So what's your LTCG as of now? LTCG as of now will be 9 lakh rupees. Now tell me, is any exemption possible? Assessee is selling an urban agricultural land. Assessee is buying a rural agricultural land. Now tell me, which section exemption will you talk about? Selling an urban agricultural land, buying a rural agricultural land. You will think about section 54B, but blindly will I put the number over here? No, I will check my conditions. Come on, tell me 54B, what are your conditions? Condition number 1, assessee has to be individual or HUF. Keep telling me, are the conditions fulfilled or not? Is your assessee individual or HUF? Yes, he is. Then capital gains can be any kind of capital gains, guys. Long term, short term, doesn't matter. Then what is a capital asset transferred? The capital asset transferred should be an urban agricultural land which for minimum 2 years has been used by the assessee or by his parents or by the HUF, as the case may be, for agricultural purpose. Is this condition fulfilled? Now, did you understand why this information is given? Some of you would have thought, oh, irrelevant information. Not irrelevant information. Perfectly relevant. It was being used by his father for agricultural purposes during last 2 years and 8 months. Why have they mentioned this? Because in 54B, the asset that you're transferring has to be an urban agricultural land which for the last 2 years at least has to be used by the assessee or his parents or his HUF for agricultural purposes. Is the condition fulfilled? Yes, the condition is fulfilled over here. The parent, the father is using it for agricultural purposes for at least 2 years. Condition fulfilled. Then what is a new capital? What is a new asset? What is a new asset we should be buying in 54B? Some agricultural land can be urban or rural, doesn't matter. Then within how much time should we be buying, guys? What's the time limit? You should buy the new agricultural land within 2 years from the date of transfer. Check whether that is fulfilled. See, when did we sell the land? 1st December 25. This is the date of transfer. When did we buy the new land? 10th March 26. So did we buy the land within 2 years from the date of transfer? Yes, guys. All my conditions seem to be fulfilled. 54B exemption I will get. But before giving the exemption, I will also check whether CGD account will be relevant over here. Will capital gains deposit account be relevant over here? Capital gains deposit account will be relevant, guys, only if my assessee is buying the new asset after 139 date. See, is he buying after 139 date? Very simple, okay. My current year is 25-26 previous year. For this year, what are the possible 139 dates? Tell me. It will either be 31st July 26 or it will be 31st October 26 or it will be 30th November 26. Only 3 dates are possible, 139 dates. When your assessee purchase a new asset, 10th March 26 itself. So, are you noticing? 10th March 26 is before 139 date. So whatever be the 139 date, assessee has purchased a new asset within 139 date. So therefore CGD and all will not come into the picture. CGD will come into the picture only if assessee is purchasing the new asset after the 139 date. Then only you will think about CGD. But here he is purchasing their new asset before 139 date. So CGD dustbin. So come on, guys. All your conditions are fulfilled. Now at least will you give me the exemption? 9,50,000. Can I subtract 9,50,000? If I subtract 9,50,000, I will get a negative number. Is that okay? No. Exemption cannot be more than the capital gains. So therefore you will restrict it to 9 lakh rupees. So what's your taxable capital gains now? Taxable capital gains is 0. This was pretty interesting. Yes, guys, can I take you forward now? Come on. Only 2 more adjustments left. Interest credited in PPF. PPF interest, tell me. Exempt or taxable? PPF interest will be exempt. But guys, my assessee is following 115 BS, then? Doesn't matter, still exempt. Doesn't matter which regime, PPF interest is always exempt. Which head of income? Salary head of income or IFOS head of income? PPF interest always goes to IFOS head of income, guys. Under IFOS, it's going to be fully exempt. Okay, then your favorite adjustment. He paid 75,000 life insurance premium for self and wife with section. Life insurance premium ATC. He contributed 1 lakh towards PPF with section PPF ATC. So total ATC over here is how much? 75,000, 1 lakh. Total ATC is 1,75,000. You will restrict it to how much? You will restrict it to 1,50,000. But assessee is following default regime. In default regime, will you give ATC? In default regime, you will not give ATC. But please have in your mind that had it been normal regime, I will get 1,50,000 ATC. Got it, everybody? So this is my entire story. Can we just see what are our learnings in the question? What was your first learning in the question? I'll tell you. The first light bulb moment for you was let out property, interest, no limit. Self-occupied property, you will think about limit, but let out property, no limit. Then what was your next learning? I think this was very interesting. This household LED and refrigerator point, they tried to confuse us by making us think about capital gains, but we know better that these are personal effects, therefore no capital gains. Then this, I think, is a highlight of the question, guys. Used by his father for agricultural purposes during last 2 years. Some students will think, why is that information even given? But we know now that this information is given for 54B. Okay, then 54B exemption calculation and all was okay. Then PPF interest, IFOS head exempt, and ATC, anyways, that was a basic adjustment. So now come to the question. Let's see what are they asking us. Salaries head. Under salaries, how much is taxable? We finished the calculation. 8,01,960, option B. Then they asked us capital gains. Capital gains, even that we finished. That was 0, I think. Capital gains was 0, guys. So option C. Then third subdivision, total income. Total income we will have to calculate. So total income of your SSE. Which regime are we doing the computation as per? Default regime. So salaries income was 8,01,960. 112 LTCG was 0. Any other income SSE is having? IFHP loss is there, guys. Loss of 94,000 I am having. So I'll put loss in the margin for one moment. I will handle it in a minute. IFOS total is 4 lakh rupees. No other income, guys. Tell me, loss from house property. Can I adjust against salaries? Interhead and all, can I do? No. Assessee is following 115 BAC. No. In 115 BAC, if you have loss from house property, what you can do? Only intra-head only you can do. Inter-head, no. Carry forward, no. Bring forward, no. Nothing else you can do. You can only do intra-head adjustment. Tell me, is intra-head possible? Do I have any income from house property, guys? Is intra-head even possible in this question? Intra-head is not even possible in the question because I don't have any other IFHP even left with me. So what will happen to this loss from house property then? Only intra-head is possible. Intra-head we can't do over here because I don't have any IFHP. Inter-head you will not allow. Carry forward you will not allow. So what will happen to the loss? The loss will simply lapse. That's all, guys. So what's the total income of the SSE? Total income of the SSE will be 12,01,960, already in multiples of 10. Therefore, I will not think about any rounding off and all. Option A. Okay. Now come to the last subdivision. The last subdivision is asking us what will be the total income of Mr. Roshan if he opts out of the default regime. Opts out means what? As per normal regime, we have to compute total income. Can we begin? Total income as per normal regime. Am I going to sit and calculate all over again fully? No. I will simply take the total income as per the default regime and I'll play with that number. How much is the total income as per default regime? 12,01,960. Now no overconfidence, okay. Go from the beginning and see adjustment by adjustment what to change. Salaries head, what should I change, guys? I enjoyed 75,000 standard deduction, but normal regime only 50,000 you will get. So 25,000 extra you enjoyed. So I have to reverse 25,000 extra. So standard deduction, assessee enjoyed 25,000 extra in 115 BAC. So now I'll add back 25,000. Then anything else? Let out property, nothing will change. Let out property, something will change. What? In normal regime, at least you will let me do interhead. No. Come on, guys. In default regime, only full restrictions on me. But in normal regime, intra-head also allowed, inter-head also allowed, carry forward also allowed, bring forward also allowed. Everything is allowed. But one small catch. Inter-head maximum, how much you will allow? Inter-head maximum 2 lakhs you will allow. Okay. Here it is 94,000 only. It is within 2 lakhs. So fully you will let me adjust. So loss from house property, 94,000. Fully I adjust. Again salaries itself I'll adjust off. Then what else is there? See. Capital gains will change because of normal regime, default regime. Capital gains will stay the same only. Then ATC. ATC was how much? ATC is 1,50,000. That's it. So what's your total income? As per the normal regime, I am getting 9,82,960. Please check whether your number and my number is matching. 9,82,960. Yes, guys. I am starting with question number 2 now. Question number 2 is a pure salaries question, a descriptive question. Again, it's an RTP question. Alright. The question says Miss Nisha is marketing manager in Rose Limited. She gives you the following details for 25-26. So, lot of information they have given to us. Compute income chargeable to tax under salaries head in the hands of Miss Nisha for assessment year 26-27 under optional regime. Guys, what is optional regime? Optional regime is nothing but your normal regime. So under normal regime, we have to compute taxable salary. Alright. Let's begin. Salary computation, normal regime. Will you take a no silly mistake challenge? Will you ensure that you don't make any silly mistakes over here? Try being as perfect as you can, okay? Basic salary 45,000 per month. Okay, 45,000 per month. How much is that? 5,40,000. Done. Then DA is 10,000 per month. DA 10,000 into 12. 1,20,000. Keep in mind 30% only is forming part. Then bonus is 1 month basic salary. So basic salary is 45,000 per month. 1 month basic salary we are getting as bonus. So bonus will be 45,000. This is also easy. Then comes the next adjustment. She contributes 18% of her salary, basic plus DA, towards RPF. And company also contributes same amount. How many adjustments can you see over here? I can see 2 adjustments. She contributes. So employees contribution also we are having. Company contributes. So employers contribution also we are having. Both contributions we are having. Can we start doing one by one? Let's focus on employees contribution first. I'll give reference to working note 1. Now working note number 1, employees contribution. How many things will come to your mind? Employees contribution to RPF, guys. 2 things will come to your mind. Thing number 1. How much is the employees contribution? Give me the amount first. The amount is 18% of salary, basic plus DA. So 18% of basic plus DA. Basic is 5,40,000. DA is 1,20,000. 18% of 5,40,000 plus 1,20,000. How much is this? This is going to be 1,18,800. This is the actual contribution, okay. So first of all, you will put this under ATC. ATC 1,18,800 you will get as a deduction. But please answer my question. In this question, I am computing salaries head. In salaries computation, will ATC impact my answer? No, because ATC is a part of chapter 6A. From GTI only, you subtract chapter 6A to get total income. I am doing only salaries calculation. In salaries calculation, ATC will first of all not enter my story. Okay. Then there's one more thing, guys. There's one more thing which you should think of. I'll tell you. We'll see how much is employees contribution. 1,18,800. We will see, is it more than 2,50,000? If it is more than 2,50,000, we will find the excess. Is excess taxable? No. On this excess, whatever is the interest, that interest alone will be taxable. Here tell me, is it more than 2,50,000? No, guys. Here it is only 1,18,800. It is not more than 2,50,000. Just reminding you that had it been more than 2,50,000, then excess will not be taxable. Interest on the excess will be taxable under your salaries head. Okay. So now tell me, in this question, employees contribution, should I do anything? ATC, I will not do, guys, because they are only asking me salaries head. In salaries computation, ATC will not impact my answer. Then only if it is more than 2,50,000, only then you will tax the interest. Here it is not more than 2,50,000. So therefore even this will not affect my answer. So can I say employees contribution, dustbin? Nothing to do. Now come on, come to employer's contribution, everybody. So come to your main answer, employer's contribution, working note number 2. So guys, second time we are going to be doing employer's contribution. Same style we'll do together, okay? Same way like what we did in the last question. How to start? First I will compute salary for employer's contribution. Salary will have how many components? 3 components, guys. Basic salary, DA forming part, and employees turnover based commission. See, what's the basic salary? Basic salary 5,40,000. So, one second. Here. Basic salary 5,40,000. What about DA? DA forming part I have to take. Only 30% is forming part, guys. My total DA was 1,20,000. Only 30% is going to form part, which is going to be 36,000. And we don't have any commission. So what's your salary for the purpose of RPF? 5,76,000 will become your salary for the purpose of RPF. Easy. Then comes your second subdivision. What's your actual employer's contribution? Actual contribution. The question says actual contribution is 18% of basic plus DA. So 18% of basic salary plus full DA. How much is that? 1,18,800. Guys, are you able to see a potential silly mistake area over here? I am able to see something. Are you also able to see something that we could have made wrong? We should not take 18% of this number. Right, guys? The question says actual contribution is 18% of basic plus DA. So I also will take basic plus DA. Did they say DA forming part? They didn't say DA forming part. So even I will not take DA forming part. I will take full DA. Okay. So actual contribution, when you're computing actual contribution, no. That time this number is irrelevant, guys. Then why did you do this computation? You did this computation for the purpose of exempt contribution. How much will be exempt? Tell me. 12%. 12% of this 5,76,000. How much will that be? That will be 69,120. Then comes your fourth step, taxable contribution. What will be taxable now? Easy. Received minus exempt. I received 1,18,800, out of which 69,120 is exempt. So what will be your balance number? 49,680. This will be taxable. Okay, then even in the last question I made you think something. Same thing I will make you think even over here. Is employer's contribution to RPF plus superannuation fund plus NPS put together, is it more than 7,50,000, guys? No. How much is the employer's contribution? Employer's contribution is only 1,18,800. Is it more than 7,50,000? No. Had it been more than 7,50,000, what would you have done? You would have found the excess. Excess will be taxable as perquisite. Then you will find interest on the excess. Even interest on the excess will be taxable as perquisite. But here it is not more than 7,50,000. So no tax implications. So how many tax implications over here? Only one tax implication. 49,680. Come on, everybody. Take it to your main answer. 49,680. This is also done. Now are you ready for the motor car adjustment? Come on. Let's read the question. The question says motor car owned by the employer. Car is owned by the employer. Cubic capacity is exceeding 1.6 liters. So cubic capacity is more than 1600 cc. Provided to Miss Nisha from 1st November. Which means how many months? November, December, Jan, Feb, March. Computation will be only for 5 months. It is used for official and personal purpose. So car is owned by employer, used for official and personal purpose. Now comes the game-changing sentence. Repair and running expense of 50,000 were fully met by Nisha. So expenses are fully met by employee. Tell me, guys, how will you compute? Working note number 3, car. Who owns a car? Car is owned by employer. Who is incurring the expense? Expense is incurred by employee. Car is being used for official and personal purpose. Does any number come to your mind? Car is self-driven by the employee. Cubic capacity is more than 1600 cc. Does any number come to your mind? Car is owned by the employer. Expenses incurred by employee used for official and personal purpose. In this category, guys, if the cubic capacity of the car is up to 1600 cc, then 600 per month is taxable. If the cubic capacity is more than 1600 cc, then 900 per month is taxable. If along with the car, driver is also provided, then you will add another 900 per month, guys. But here the car is self-driven by employee, so no driver and all. Here the car's capacity is more than 1600 cc. So more than 1600 cc, 900 per month. How many months? We already decided how many months. 5 months. So total taxable amount will be how much? But 4,500. But do you remember that this perquisite will be taxable for specified employees only? Yes, tell me guys, is my assessee a specified employee? Let us check. See, his salary number is definitely more than 4 lakh. Right? If your salary number is more than 4 lakh, then you will become a specified employee. If I look at the salary numbers, we have big numbers over here. Definitely it is more than 4 lakh. My assessee is a specified employee. So car perquisite will be taxable for the assessee 4,500. This was easy. Then come to the 6th subdivision. Company pays medical insurance premium of 18,000 to effect insurance on the health of Miss Nisha. Tell me, health insurance premium paid by employer, exempt or taxable? I'll give you a small tip over here. Life insurance premium, if paid by employer for the employee, that will be taxable. Only life insurance premium paid by employer for employee will be taxable. All other premiums, health insurance premium, personal accident insurance policy premium, staff group life insurance premium, all other premiums will be exempt. Only life insurance premium paid by employer only will be taxable. This is medical insurance premium, guys. This will be fully exempt. Easy. Then come to the 7th adjustment. Employer gave him rent-free accommodation. Rent-free accommodation you always do last. Then come to the 8th adjustment. Company incurred expenses on the treatment of her daughter abroad. Treatment abroad, including stay expenses, 1,50,000 permitted by RBI. Can I give you a super quick revision of this concept? Listen to me. Medical treatment abroad. So when there's medical treatment abroad, there are 3 types of expenses that are possible. Number 1, treatment expense. Number 2, stay expense. And number 3, travel expense. So you will have 3 expenses relating to abroad medical treatment. Now treatment expense and stay expense, if employer is meeting this expense for you, then in that case, up to the RBI limit, it will be exempt. Are you listening, everybody? Yes. So if the question is about employer meeting treatment expense and stay expense, the employee or his family member requires medical treatment abroad. So for that medical treatment, the treatment expense and the foreign stay expense, if this expense is met by the employer, then up to the RBI limit, it will be exempt. What does the question say? The question says company incurred expense for treatment of a daughter abroad and stay. So that they are also talking about treatment expense and stay expense, guys. How much is the expense? 1,50,000. But the question is saying this 1,50,000 is permitted by RBI, which means what? Which means that here this 1,50,000 is within the RBI limit. It is permitted by RBI. So because it is within the RBI limit, what will be the tax treatment of this perquisite? This perquisite will be fully exempt. Okay, you got the point? So medical treatment and stay expense, if employer is meeting for the employee, it is within RBI limit, therefore it is exempt. What if it was more than RBI limit then? Then whatever is the excess above RBI limit, whatever is the excess, no, that will become taxable. Okay, here it is within RBI limit, therefore it is going to be exempt. So medical treatment plus stay, exempt. Okay, this is also done. Then comes the 9th adjustment. Listen to me. What was the 4th adjustment over here? Travel expense. What about this now? If the employer is meeting your travel expense for abroad medical treatment, listen to me carefully. Either this travel expense will be fully exempt for you or this travel expense will be fully taxable for you. So how many possibilities? There are only two possibilities. Either the travel expense which the employer is meeting for you will be fully exempt, or the travel expense which the employer is meeting for you will be fully taxable. There are only two possibilities. Now, when will the travel expense perquisite be exempt? If GTI of the SSE is within 8 lakh, then it will be exempt. But if the GTI of the SSE is more than 8 lakh, then this travel expense which the employer is meeting for the employee will be fully taxable. Are you understanding, everybody? So whether it is exempt or whether it is not exempt, it is depending upon what? It is depending upon GTI. If GTI is within 8 lakh, then exempt. If GTI is more than 8 lakh, then the travel expense will be taxable. Now come back to my question. Look at the numbers over here. If you add up, how much are you getting? As of now, I am getting 7,59,180 as of now I am getting. Then I have to subtract standard deduction, and then I need RFA number also. So I need to do all those calculations. I need to check whether the GTI of my assessee is within 8 lakh or more than 8 lakh. On that basis only I can answer. So can I keep the travel expense perquisite pending for now? Because I have to wait and see how much is the GTI. Only if it is more than 8 lakh, I can tax this 80,000 rupees. If it is within 8 lakh, I can't tax this 80,000 rupees. So I'll have to wait and see how much is the GTI. Okay, so that's it, guys. Can we do the RFA adjustment now? That's the only adjustment that we are left with. So RFA, I'll give reference to working note number 4, I think. Working note number 5. Working note number 5. Come on. I'll open working note number 5 for RFA. Tell me, how do I start RFA computation, guys? How do I start? Is my employee government employee or non-government employee? Non-government employee. Does the employer own the house, or has the employer himself taken the house on lease? I don't know. Let's read the question. Her employer gave him RFA in Mumbai from 1st April 24. 1st April 24 means what, guys? Previous year? 24-25. Current year or last year? Last year. So last year my SSC got RFA. Okay. House was taken on lease by Rose Limited for 12,000 per month. So the house RFA is taken on lease by employer. Okay. The lease rent is 12,000 per month. Perquisite value of the accommodation for 24-25. So last year's RFA value they have given to us 55,000. Then they have given us CII numbers. Come on, let's begin. Tell me, guys, if RFA is taken on lease by the employer, what will the taxable value be? Does the taxable value depend upon population? No, only when the employer owns the house, then only you will bother about population. Here the house is taken on lease by the employer. I don't care about the population. Straight away, 10% of salary or rent paid by employer, whichever is lesser. Whichever is lesser will be what? Exempt or taxable? This is perquisite. Whichever is lesser will be taxable. So what do I need now? I need to find salary. So come on, everybody. Let's do the computation. Salary will have how many components in RFA? Salary will have many components. It will have 7 components. Salary for the purpose of RFA. We will take basic salary. We'll take DA forming part. Then we will take all commission. All commission means what? Whether it is turnover based commission, whether it is fixed commission, doesn't matter. Then we will take bonus. We'll take fees. We'll take taxable allowances. And then we will take any other taxable monetary payments. So 7 components we will have in salary. Come on, let's carefully search these numbers and bring them to our working note. What's our basic salary? Basic salary is 5,40,000. Okay. DA. DA is total 1,20,000. But remember how much is forming part, guys? Something was written over here. 30% only is forming part. That's going to be 36,000. Then we read the whole question. Did we have any commission? We did not have commission. But did we have bonus? Yes, remember, we had 1 month salary as bonus in the question. Right here. Bonus was 45,000 for us. So bonus 45,000. Then we don't have any fees. Do we have any taxable allowances? Let us check. Do we have any taxable allowances? See over here. Any taxable allowance? No taxable allowance. Then do we have any other taxable monetary payment? Any taxable monetary payment? Employer's contribution you should not take. All this is perquisite. So we don't have any other taxable monetary payment also. That's all. So what's your total salary for the purpose of RFA? 6,21,000 guys. This is salary for the purpose of RFA. Now come back. 10% of 6,21,000, which is 60 to 100, or rent paid by employer. How much rent is paid by employer? See, given to us over here. Rent paid by employer is 12,000 per month. So 12,000 into 12, 1,44,000. Correctly tell me, slowly tell me, out of these two numbers, which number will you pick? Whichever is lesser. Which is lesser over here? 60 to 100. This will become the taxable value. Okay, but problem is there. What's the problem? They have given us the perquisite value of the accommodation for 24-25. Last year's number they have given, guys. So therefore I will have to index, right? So this is the taxable value of the current year RFA. Now I will find indexed RFA of 24-25. 24-25's RFA is 55,000. How do you index it? Into CII of the current year, which is 376, divided by CII of 24-25, which is 363. Usual indexation, guys. So 55,000 into 376 by 363, I will get 56,970. Okay, now listen carefully. 60 to 100 is a taxable value of the current year. Last year's taxable value was 55,000, which we indexed it, and that indexed value is 56,970. Out of these two numbers, which one will you take? Out of these two numbers, you will take whichever is lesser. So what's your final taxable number now? 56,970 will become your taxable number. Easy. I first did the computation of the current year. When I did the current year calculation, did I bother about the last year number? I didn't bother. I did my current year calculation fully, nicely, properly I did. Then I saw, oh, they have given me last year's number. So that last year's number I indexed. So now I will compare my current year number with my last year's index number. Out of these two, whichever is lesser, this will become my final RFA. So what's my final taxable RFA now? 56,970. Okay guys, now please have a look at the GTI. If you ignore the travel expense, what's the GTI of the SSE? How much is this entire total? I need to find out the GTI of my SSE. I am getting 8,17,150 guys. Then you will get standard deduction 50,000. So what will your taxable salary become? Your taxable salary will become 7,66,150. Then does the question say SSE is having other income and all? No other income guys. So GTI of the SSE will be, ignoring the travel expense perquisite, it will be 766,150, which is less than 8 lakh. So because this is less than 8 lakh, the travel expense, the foreign travel expense for abroad medical treatment met by the employer, what will your answer be? It will be fully exempt. Are you understanding? Yes, I need you to get used to this adjustment because amendment highly expected from your examinations point of view as well. The travel expense which is met by the employer, 80,000 travel expense, will either be exempt or it will be taxable. Whether it is exempt or taxable, that depends upon GTI. Here the GTI of my assessee is within 8 lakh. Because it is within 8 lakh, the travel expense met by the employer is fully exempt. Guys, what if GTI was more than 8 lakh? Then what would you do? If GTI was more than 8 lakh, then this entire 80,000 which the employer is meeting for me, right? This entire 80,000 would have become taxable. Okay guys, but here GTI is within 8 lakh. So therefore the travel expense met by the employer will be exempt only. That's all. Close your answer now. What's the gross salary of your assessee? Gross salary is 8,16,150. From this section 16 standard deduction, 50,000. There is no professional tax over here. No entertainment allowance over here. That's all, story over. 7,66,000 150 will become your taxable salary. Easy. Can you tell me what were your learnings in this question now? Come on, let's go from the beginning. What were your learnings in the question? Initial part was simple, basic, DA, bonus was okay. Then employer's contribution to RPF. Second time we are seeing this adjustment, so I will not call this as a learning. Motor car. Some of you got confused about the motor car point. Because cubic capacity is more than 1600 cc, I will take 900 per month. Had the cubic capacity been within 1600 cc, I would have taken 600 per month. Had driver also been given along with the car, then I would have added 900 per month. Okay, I will call motor car as your first big learning in the question. Then any other learning, guys? Medical insurance premium you all were able to answer correctly. RFA was interesting. RFA was interesting over here because they had given last year's RFA number. So when they give me last year's RFA number, then I will index that last year's number. So whatever is my current number, whatever is the indexed number, out of these two, which numbers I will pick? Whichever is lesser number. Okay, then after that, this adjustment definitely I will highlight, guys. This entire adjustment was your big, huge learning, a very, very important learning because of the amendment. What is the learning? When the medical treatment is abroad, how many expenses are possible? 3 expenses are possible. Stay expenses, treatment expenses, and travel expenses. For stay expenses and treatment expense, do you care about GTI? You don't care about GTI. If the stay expense and treatment expense is within RBI limit, then exempt. If it is more than RBI limit, then whatever is the excess above RBI limit, that is taxable. Life is simple over there. Only if it is travel expense abroad, there only you have to be little careful. You have to find what's a GTI. If GTI is within 8 lakh, then in that case, the perquisite, the travel perquisite will be fully exempt. But if the GTI is more than 8 lakh, then the travel expense will become fully taxable. Got it, everybody? Can I close this question? Can I go to the next question, guys? Come on, come to question number 3 now. Question number 3 is also from your RTP. This is the last question we are working from RTP. After this, we will go to the mock test paper. This is your proper full-fledged total income question, guys. So let's see what the question is saying. It's an amazing question, has some very good adjustments. The question says, Mr. Yuvan, a resident individual aged 45 years. So what would you like to conclude over here? That Mr. Yuvan, you are not a senior citizen. Okay, he is engaged in manufacturing. As soon as you see manufacturing, does something come to your mind? Only one thing will come to your mind, guys. Additional depreciation. He follows mercantile system of accounting. Okay. Lot of adjustments are given. What are they asking us? Total income and tax liability of Mr. Yuvan under default regime also, under optional regime also. Both the regimes we have to compute total income also, tax liability also. Are you ready for the game? Can we begin? Yes, we'll first do as per normal regime, then we will do as per default regime. So I'm doing total income calculation as per normal regime first, then later we will do as per default regime. Okay, come on, guys. So first, net profit as per P&L account, which means I'm having PGBP head. I'll give reference to working note number 1. I'll open my working note number 1, PGBP head. So what's my net profit number? Net profit as per P&L after debiting or crediting the following items is 20 lakh rupees. So because I have the net profit number, how will you compute PGBP, guys? Indirect method, the 5 steps method, disallowances, all that you will think about. So let's read the question. I'm not making the 5 headings. I'm going to straight away start solving over here, okay? Please keep in mind, all these adjustments are already debited and credited. First, 25,000 paid to creditor for goods in cash. What to do? 25,000, more than 10,000. We have paid to creditor for goods, which means this is purchase expense, more than 10,000. We have paid in cash. Cash is non-specified mode. So under section 40A subsection 3, we will disallow. So section 40A subsection 3, we will add back payment which we have made to creditor in cash. I have a question. Will you add back the excess 15,000 or will you add back 25,000 fully? Fully, guys, it is full disallowance. Full 25,000 you will disallow. I'll tell you why I'm asking you. I'll tell you. Do you remember in your PGBP chapter, you have section 40A subsection 2? I'll tell you what 40A subsection 2 is. The section which says assessee is incurring an expense, other party is relative, and the expense is excess or unreasonable. Huh? That section, okay. There, what do you disallow? There only excess portion you disallow. There you don't disallow whole expense. Only excess portion you disallow. This is 40A subsection 3. What is 40A subsection 3? More than 10,000 rupees, you are making payment in non-specified mode. In 40A subsection 3, here you disallow fully. Okay, you understood why I am reminding you this. So in 40A subsection 2, I disallow only excess. But 40A subsection 3, I disallow fully. Just wanted to remind you that one point. Basically, it's a potential silly mistake area. So be careful. 40A subsection 3, I will disallow it fully. Done. Then, gross interest received from savings bank account. You tell me, guys, savings interest is credited in my P&L account. What will I do? I will not straight away take it to IFOA step by step. First, PGBP, what should I do? It is credited to P&L. So you will reverse the credit. You will debit it. You will remove it. You will debit it. So savings account interest. What is the amount? 15,000. I'll remove it from PGBP and take it. Now where will I take it to? IFOS head. So I'll come to my main answer. IFOS working note number 2. So after working note number 1, I'll open my working note number 2, IFOS, post office savings interest. Amount is 15,000. Does anything else also come to your mind? Don't you think I will think about ATTTB, ATTTA also? Here my assessee is not a senior citizen, guys. Therefore, ATTTA. Will I give 3,500 exemption, by the way? Interest plus post office plus savings account, then only you will give me 3,500 exemption. Only if it is interest from post office savings account, then only you will give me 3,500 exemption. Is this post office savings account? No. This is saving bank account. Bank account savings interest, no 3,500 exemption. But ATTTA I will still have. ATTTA will go to chapter 6A. So I'll open working note number 3 for chapter 6A. And in chapter 6A, I will write ATTTA. Amount is 15,000, guys, but maximum how much you can give me deduction in ATTTA? Maximum 10,000 only. Sorry, assessee. Okay. Now come to the third subdivision. Contribution to approved research association for scientific research 1,10,000. Slowly. In normal regime, allowed or not allowed? In normal regime, this is going to be allowed, guys. Contribution to outsider for scientific research, section 35, contribution to outsider will be allowed. Right now we are computing as per normal regime only. It is already debited to P&L account. Anything left for me to do? Nothing is left for me to do. But do you remember, later we have to compute as per default regime also. In default regime, is contribution to outsider allowed? In default regime, contribution to outsider is not allowed. So when we do default regime, that time we have to remember to add it back. So in default regime, I have to add it back. I have made a note over here. I will not forget. Okay. Then comes the next adjustment. He paid job charges for value addition on the fabric 1,10,000 without deducting tax to job worker by account payee check. Without deducting tax, what will you do? Assessee has incurred an expense, job charge expense. I'll assume the expense is relating to his business or profession. And assessee has not deducted tax at source. Job charges under 194C, you should have deducted tax. Amount is 1,10,000, more than 1 lakh rupees. In 194C, you should have deducted tax. But did your assessee deduct tax? Assessee did not deduct tax. So if you were making payment to non-resident, then how much will you disallow? Then 100% only you will disallow. But does the question say we are making payment to a non-resident over here? No. So therefore I will assume payment is to a resident. Therefore I will apply 40A1A. In 40A1A, how much I will disallow? Only 30% of the expense I will disallow. As soon as you say 30% I will disallow, assessee is sitting and crying in the corner. How will you console the assessee? What will you tell the assessee? Don't worry, assessee. For now I am disallowing. But later whenever you rectify, later whenever you deduct the tax and remit the tax, that time once again we will allow it for you. It's a reversible disallowance. So come on guys, come back to your PGBP. You're going to disallow under 40A1A. Job charges amount is 1,10,000 into 30%. 33,000 is what you're going to disallow. You're going to add back. Okay. Then comes the fifth adjustment. Normal depreciation of 4,50,000 as per income tax rules includes depreciation on 15 lakhs being the cost of new machinery purchased and put to use on 1st September. Subsidy of 20% on new machinery under Technology Upgradation Fund scheme from the central government was credited to P&L account. 2 adjustments, 1 story. Carefully listen to me. This adjustment is a highlight of the question, but if you pay a little extra attention, it will not be a big challenge. They are saying that all these adjustments are already debited or credited. So in that debit or credit, normal depreciation of 4,50,000 has already been debited. And that 4,50,000 includes depreciation on 15 lakhs, which is cost of new machinery purchased and put to use. So, and they are also saying for that new machinery, we got subsidy and all. So, which means for this new machinery, I have to recompute depreciation and all. So, I'll do one thing. I'll make life easy for myself. Whatever has been debited, let me reverse it. Then freshly let me calculate again the correct depreciation. And the correct depreciation I will allow. Okay guys, so tell me how much depreciation has already been debited with regard to the new machinery. You can't say 4,50,000. No, you can't say 4,50,000 because 4,50,000 is total normal depreciation. That total normal depreciation includes depreciation on 15 lakhs. So on 15 lakhs, 15%, how much assessee would have enjoyed? Assessee would have already claimed 2,25,000 guys. Yes, so I'm adding that back. I'm reversing that and now freshly I'm going to calculate depreciation. Okay, did you understand? Potential silly mistake area once again over here. Normal depreciation 4,50,000 has been debited. This 4,50,000 is not depreciation on new machine. This is total depreciation which has been debited. Read carefully. That 4,50,000 includes depreciation on 15 lakhs. So only on this 15 lakh only, now I'm going to recompute and all. So on this 15 lakh, 15% assessee would have claimed, which I'm reversing. I'm adding back. Now freshly I'm going to calculate depreciation under section 32 on the new machine. Tell me guys, normal depreciation, how much will you let me enjoy? We got 20% subsidy. So how much amount will enter into the block? Only 80% of the amount will enter into the block because 20% subsidy we are getting. So 15 lakh into 80% only will enter into the block. What's the depreciation rate? 15% depreciation rate. Put to use on 1st September. Definitely put to use for at least 180 days. So I will get full year's depreciation. So 15 lakh into 80% into 15%, 1,80,000 is my correct normal depreciation. Till here, did you understand? Everybody, these 2 adjustments give me a big fat yes if you understood. Yes, whatever depreciation they already debited, I reversed that. Then I correctly calculated depreciation. When I correctly calculated depreciation, that time I was careful. 20% subsidy which I got, I remembered to remove that. On that 80% number only, I claimed depreciation. Now tell me guys, normal regime, assessee is a manufacturer, plant and machinery. So now I will come to additional depreciation. So same thing, 15 lakh into 80%. This is the amount that will enter into the block. What's your additional depreciation rate? Put to use at least 180 days guys. So full 20% additional depreciation you will give me. That will work out to how much? That will work out to 2,40,000 rupees. And guys, are you also making a mental note that later we have to do as per default regime? That time we have to remember to reverse this additional depreciation. Make a mental note for yourself. Okay. Now read the subsidy adjustment. Subsidy of 20% on new machinery under Technology Upgradation Fund scheme from central government was credited to P&L. Is it okay? They credited the subsidy in P&L account. Maybe it is okay from accounting point of view, but not from income tax point of view. Income tax point of view, subsidy is going to be a capital receipt. And this subsidy we have reduced from the block. So therefore you can't credit it to P&L. So what will you do now? How will you reverse a credit? It's already credited. How will you reverse a credit? By debiting it. Debiting means what? You will subtract. So you will subtract the subsidy which is already credited. How much is the subsidy, guys? 15 lakh into 20% is the subsidy. 3 lakh rupees. I am going to subtract it. This is also done. Once I am done with this adjustment, my tension is over. Rest of the adjustments are simple only. Come to the next adjustment now. Insurance expense includes 50,000 deposited with Insurance Corporation of India for life, for maintenance of her mother, aged 70 years, dependent upon him and suffering from severe disability. Step by step. What should I do in PGBP head? In PGBP, they are saying we have debited insurance expense, which includes 50,000 for mother. So first of all, 50,000 will become personal expense, not relating to business. So you will disallow, you will add it back. Insurance, 50,000, you will add it back. Then, assessee is having mother, relative. That mother is dependent on the assessee. And that mother is suffering from severe disability. Which section will you think of? Section 80, D. Very good. Chapter 6, 80DD. In 80DD, tell me, does it matter how much your assessee has actually spent? Does it matter? It doesn't matter. You will get a flat deduction. Flat deduction how much? If it is disability, then 75,000. If it is severe disability, then 1,25,000. Here the question is saying severe disability. So therefore, 1,25,000. I'll tell you one more thing. Will you listen to me? Here they are saying severe disability. Sometimes they will give percentage. If the disability percentage is less than 40%, then you will not consider it as disabled. If the disability percentage is at least 40%, but less than 80%, then you will consider it as disability. Disability means 75,000 deduction you will give me. But if the disability percentage is at least 80%, this is called as severe disability. Here you will give 1,25,000 deduction. Got the point, everybody? Yes, so this was your 7th subdivision over here. Then come to the 8th subdivision. General expense includes revenue expense for promoting family planning amongst employees, 75,000. Do you know something about this adjustment? Expense for promoting family planning amongst employee. This will be allowed for whom? This will be allowed for company assessee only. But is your assessee company? Who is your assessee? Mr. Yuvan, he's an individual. So for assessee, individual assessee and all, this will not be allowed. So it's already debited. How will you reverse a debit? You will add it back. So general expenses. General expenses amount is 75,000. I'm adding it back. This was also simple. Then comes your next adjustment. Will you promise to be awake when I'm reading the next adjustment? No sleeping. Very, very important adjustment. Carefully you will read. Without any mistake, you will give me the answer. You will imagine you're reading this adjustment in the examination. You will expect accuracy from yourself, right? That same accuracy I want from you. Let us see. On 1st March 26, Mr. Yuvan purchased raw material for 30,000 rupees from Kanha and Company, a medium enterprise. Micro enterprise? No. Small enterprise? No. Medium enterprise. As per MSMED Act 2006, for which payment was made on 18th April 26. There was no agreement for payment period between them. What to do? You look at me, I look at you. After some time, we all go home and sleep. Will 43B apply over here? Will I do 15 days thinking over here? No. Listen, guys. First thought, no doubt, first thought that will come to your mind is 43B. 43B says, if assessee has to make payment to a micro entity or to a small entity, for that payment, you have to ensure payment is made within section 15 time limit. If payment is made after section 15 time limit, then you will disallow. For micro and small entity only. But here assessee is making payment to medium entity. If you make payment to medium entity, 43B is not applicable. 43B is not applicable means no question of disallowance and all. You will disallow under 43B only if micro or small entity. If it is medium entity, 43B disallowance is not applicable. You will simply see what method of accounting assessee is following. You remember question said assessee is following mercantile basis of accounting, guys. In mercantile basis, tell me, when do you allow expenses? As soon as assessee incurs the expense, you allow the expense. Whether assessee has made payment, has not made payment, you don't care, you don't bother about that in mercantile basis. So assessee is making a payment to medium enterprise. Step by step, 43B will not apply. 43B disallowance will not apply. Then what will apply? The basis of accounting. We are following the mercantile basis of accounting. So as per mercantile basis of accounting, when will we allow the expense? We will allow the expense whenever the assessee incurs the expense. When has the assessee incurred the expense? He purchased when? On 1st March 26. 1st March 26 means what? Previous year 25-26. So which is my current year. So current year this expense has to be allowed and it's already debited in the P&L. So is there anything left for me to do? Nothing is left for me to do. Dustbin adjustment. Got it, everybody? Huh? Yes. So it's a big lesson for you. Only if I'm making payment to micro entity, only if I'm making payment to small entity, then only I will put the effort of thinking about 43B. But here I'm making payment to medium entity. So 43B disallowance will not apply. 43B will not apply means then what will apply? The normal method of accounting will apply. Here we are following mercantile basis. Ma'am, where is it written mercantile basis? Are we assuming? We are not assuming. It is mentioned he is following mercantile basis. So mercantile basis means whenever he is incurring the expense, that time I will allow. He is incurring the expense in the current year I will allow. Already debited, nothing is left for me to do. Okay, now come. Additional information. Mr. Yuvan repaid housing loan, principal and interest. 75,000, 80,000 respectively. So 75,000 principal repayment, 80,000 interest payment availed for purchase of let out property. Principal repayment, what is coming to your mind? ATC will come to your mind, guys. So ATC, principal repayment, the loan should be to purchase or construct the property. Yes, it is to purchase a property. I'll assume it is a residential property. They did not say who the lender is over here. I'll assume lender is bank, housing finance company, employer, central government. That list which is given in ATC, I'll assume those conditions are fulfilled. So housing loan principal repayment, I'll put it under ATC, amount is 75,000. Okay. What about interest, guys? Keep in mind, assessee is having let out property. So when I do let out property calculation, that time we will take this interest of 80,000. Okay. Then he received rent of 3,50,000 from his let out property. Municipal tax of 40,000 for this house was paid by him on 30th April 26. Let's begin. Which head of income? IFHP head of income. Working note number 4. So after working note number 3, I'll open working note number 4, IFHP. What kind of property? Let out property. You start by checking how many months assessee owns a property for. All 12 months. Now GAV. Will I do the hard work of thinking about municipal value, fair rent, standard rent? Nothing is given, guys. I will use shortcut. Actual rent minus unrealized rent minus vacancy loss. What's your actual rent? 3,50,000. No unrealized rent, no vacancy loss, nothing. From this we will subtract municipal taxes paid. Municipal tax 40,000. Can I take this number as it is? Read. 40,000 paid when? Paid on 30th April 26. 30th April 26 is which year? This is previous year 26-27. Did your assessee pay municipal tax in current year? Did your assessee pay municipal tax in 25-26? No. So I will not take municipal tax. Municipal tax paid means what? Payment basis, right? Assessee actually has to make the payment in the current year, only then you will take. Your assessee is making payment next year, therefore you will not take. Potential silly mistake area, be careful. 3,50,000 NAV. From this you will subtract standard deduction 30%. 30% will be how much? 1,05,000. Then interest. Interest is how much here? 80,000. I won't even think about restricting it because it is let out property. So total IFHP will be, I am getting 1,65,000. Please check whether your number and my number is matching. 1,65,000. Okay. Then comes this third adjustment. Third adjustment, will you listen to me? I'll just give you one quick reminder. Then I will come to the third adjustment over here. See, I made a 5 years FD in a bank or in a post office. And the FD is in assessee's own name. What will you do? I made a 5-year FD or tax saver deposit, whatever you want to call it, in a bank or in a post office, and that FD is in assessee's own name. Does some section come to your mind? ATC deduction you will give me, guys. This comes under ATC. I'll be smart then. I'll make this FD. I'll make this 5 years FD. I will enjoy ATC deduction. Next day, I will go and break the FD. I'm capable of doing that. You're understanding the loophole over here. So I'll make the FD in a bank or in a post office in my own name, and I will enjoy ATC deduction. Then next day itself, if I go and break the FD and if I take my money back, that possibility is there. So that is why the Income Tax Act has introduced a provision. The provision says that this FD, if you do a premature withdrawal means what? 5 years are not over. You have to keep the money in FD for 5 years. No, but 5 years are not over. Even before 5 years, you're going and breaking the FD. You're making a premature withdrawal. So if you make a premature withdrawal, then it will be taxable for you under which head? Under IFOS head. Let's see if you heard me properly or not. Am I saying every FD premature withdrawal is taxable? Am I saying like that? No, I am saying when you made the FD for 5 years, if you enjoyed ATC deduction, that FD, if you do a premature withdrawal, then only it will be taxable for you under IFOS head. Okay, keep this in your mind and come to the adjustment, guys. The question says he received 75,000 by premature withdrawal from deposit, including interest 5,000. So can I say 70,000 is premature withdrawal, 70,000 plus 5,000 interest he got. Okay, so 75,000 total he got, including interest 5,000, post office time deposit, eligible for deduction under ATC. So when assessee made the time deposit, he got ATC deduction. Now he is making a premature withdrawal. So this premature withdrawal will be taxable for you under IFOS head. So come to your IFOS working note, everybody. Here, premature withdrawal, what amount will I write? Give me accurate answer. I don't want quick answer. Give me correct answer. Premature withdrawal, should I write 75,000 or should I write 70,000? Premature withdrawal is 70,000 only. The balance 5,000 is FD interest. FD interest 5,000. Assessee is not a senior citizen, super senior citizen. So I will not think about ATTTB. This is your third adjustment. Then comes the fourth adjustment. He sold a gold bracelet. Which head of income? Your favorite head of income, capital gains. He sold a gold bracelet on 1st May 25. This is your date of transfer. Sold for 5 lakhs. This becomes your full value consideration, which was acquired for 40,000. This becomes your cost of acquisition. Acquired on 1st March 2005. This becomes your date of acquisition. A diamond was embedded onto the bracelet on 1st May 2007. What is this? This will become the cost of improvement, guys. Cost of improvement is any expense that you incur which enhances the value of the asset. I had a gold bracelet. It will have a certain value. In that gold bracelet, if you insert a diamond, the value will increase, right? So that diamond will become your cost of improvement. It was incurred on 1st May 2007. This is your date of improvement. 50,000 becomes your cost of improvement. CII numbers they have given to us. Let's begin. Come to your main answer. Capital gains. Working note number 5. After working note number 4, let's open working note number 5. Capital gains. How to start? Usual process, guys. What am I transferring over here? Gold bracelet. But guys, I have a doubt. Don't you think gold bracelet is movable in nature? And I use it for personal purposes. So don't you think it should be personal effect and hence not a capital asset? It is a personal effect, but it is excluded from the list of personal effects. Because it is excluded from personal effect, it becomes a capital asset. All jewels, okay? Jewels, drawings, paintings, sculptures, work of art, archaeological collections. These 6 things excluded from personal effect and they become capital asset. So capital asset transferred gold bracelet. What's your period of holding, C? When did we acquire it? Date of acquisition is 1st March 2005. When are we transferring? 1st May 2025. We are transferring after the amendment, guys, on or after 23rd July 24. So relevant period of holding 24 months. It is more than 24 months. It becomes long-term capital asset. It is gold bracelet. 112A and all will not apply here. 112 will apply. Okay. Then I'll start my computation. What's a full value consideration, C? Here, full value consideration is 5 lakh rupees. Do we have any expense on transfer? We read the whole question. There was no expense on transfer. So this itself will become my net consideration. Then less cost of acquisition. Will I index the cost of acquisition? Long term, no. So will I index the cost of acquisition? No, guys, no. The transfer has happened after amendment. After amendment, there is no indexation. Straight away, I'll take the cost of acquisition as it is. 40,000. Then cost of improvement. I do have cost of improvement. Cost of improvement is 50,000. So what's your net number? 4,10,000. This will become your LTCG under section 112. Okay, I have a question for you. When I do the tax computation later, that time, should I do 20% with indexation, 12.5% without indexation, whichever is lesser? Should I do all that for this calculation? No. Why no? We do that calculation only if it is immovable property. Here it is gold bracelet, no? So that that computation will not come into the picture. That's it, guys. We're done with all the adjustments. Come on. Let's close our working notes one by one. Can you give me the net PGBP number? I am getting 16,73,000 PGBP. I'll take it to my main answer. Then what's your total IFOS? 90,000. I'll take it to the main answer. Then IFHP we finished already. 1,65,000. Then 112 LTCG also we finished. It is 4,10,000. So what's your assessee's GTI? $23,38,000 will be the GTI. Now I have chapter 6A. Before I subtract chapter 6A, does something come to your mind? I won't straight away subtract chapter 6A. I do have special rate income, guys. I have 4,10,000 special rate income over here. So I will split this GTI into normal rate income and special rate income. 4,10,000 is my special rate income. So the balance 19,28,000 is my normal rate income. Chapter 6A. Give reference to working note number 3. Total chapter 6A is how much? I am getting 2,10,000 total chapter 6A. I'll subtract that only against normal rate income. So my net normal rate income will be 17,18,000. Special rate income is 4,10,000. So what's the total income of my assessee now? 21,28,000 as per normal regime. Easy. They asked for tax liability also. Can we do that also together? Come on, guys. 2 minutes it will take us. Tax liability. Which regime are we following? Normal regime. And what's the basic exemption limit over here? Assessee is not senior citizen and all. Normal regime. So basic exemption limit will be 2,50,000. Now I am having a special rate income. I am having 112 LTCG of 4,10,000. So I'll draw two columns. I have normal income also. I have 112 LTCG also. Normal income is 17,80,000. 112 LTCG is 4,10,000. Come on guys, calculate tax now. Do you have any basic exemption limit over here which I can adjust against 112 LTCG? No, because my basic exemption limit of 2,50,000 will be fully adjusted against normal income itself over here, right? If I had any unexhausted basic exemption limit, I could have adjusted against 112 LTCG, but here I don't have any unexhausted basic exemption limit, so normal simple calculation only. Compute basic tax first. Normal income, guys, I'll use a shortcut number, 1,12,500 plus 30% of income in excess of 10 lakhs. How much will this be? 3,27,900. 112 LTCG, what's the tax rate? 12.5%. Will I think about 1,25,000 exemption? No, that's only 112A. This is 112. So no exemption. Straight away 12.5% tax. 51,250. So what's your total basic tax? 379,150 will become your basic tax. No rebate. Income is more than 5 lakhs. No surcharge. Income is within 50 lakhs. So straight away you will add cess at 4%. After adding cess you will get 394,316, which you will remember to round off to the nearest multiple of 10. 394,320. Done. Can I take you forward? They also asked us under default regime, guys. Let's do that now. So, total income as per default regime. Will I sit and calculate all over again? No. I will take total income as per the normal regime and I'll play with that number. What's your total income as per normal regime? 21,28,000. Don't forget this number is having LTCG. Now I'll go from the beginning. Chapter 6A first of all. I have to reverse chapter 6A, guys, 2,10,000. Because in chapter 6A, in default regime, how many sections are you allowed? Only 3 sections are allowed. 80JJAA, CCD subsection 2 and CCH subsection 2. None of the 3 sections you have over here. So therefore, whatever chapter 6A I am having, I fully reversed it. Then in PGBP head over here, anything to do? Additional depreciation I should not get, guys. Additional depreciation 2,40,000. That's it. One number only as of now. Additional depreciation, I'll reverse it. Then IFOS, nothing will change. Chapter 6A, I've already reversed. IFHP, let-out property will change? No, only self-occupied property changes. Capital gains will be the same only, nothing else is changing. But do you remember there's something which you made a note and you kept already? In your question here, you made a note and kept. Contribution to outsiders, guys. So contribution to outsiders in default regime, it is not allowed. So I will add back how much? 1,10,000. So what's your total income for the purpose of default regime? 26,88,000. Already in multiples of 10. No need of any rounding off also. Then we have to find tax liability in default regime. So which regime? Default regime. Default regime, what's your basic exemption limit, guys? Default regime basic exemption limit will be 4 lakhs. Okay. So I'll again draw 2 columns. We have 112 LTCG. How much is 112 LTCG? That stays the same only. 112 LTCG is 4,10,000, right? That stays the same only. So inside this total income, I'm having 112 LTCG of 4,10,000. So what's your normal income then? 26,88,000 minus 4,10,000. Your normal income will be 22,78,000. Did you understand? I'll tell you what I'm trying to say. We took total income as per normal regime, 21,28,000. This 21,28,000 is what? This 21,28,000 is nothing but normal income plus 112 LTCG. So when I'm computing as per default regime, here also I do have special rate income of 4,10,000, right? That's what I've written over here. Okay. Now come on, normal calculation. Basic tax. On 112 LTCG, it's pretty straightforward. 12.5%. That will be 51,250. But normal regime, here we will have to do as per slab. Tell me, 0 to 4 lakh, 0. Then 4 lakh to 8 lakh. On that 4 lakh at 5%, 20,000. Then 8 lakh to 12 lakh. On that 4 lakh at 10%, 40,000. Then 12 lakh to 16 lakh, 15%, that will be 60,000. Then 16 lakh to 20 lakhs, on that 20%, that will be 80,000. Then our income is 22,78,000. So on the excess 2,78,000, 25% tax, that's going to be 69,500. So what's your total basic tax on the normal income? I am getting 269,500. Are you getting the same thing? So what's your total basic tax? 269,500 plus 51,250, 327,50. No rebate. Income is more than 12 lakhs. Straight away I'll add cess at 4%. 333,580, which is already in multiples of 10. They did not ask for which is better and all. They're just asking us to compute. So we computed. Okay, can I summarize the question for you now? What were our learnings in the question? Come on guys. Our first learning. 48.3 and all you were able to answer. Savings account 80 TTA you were able to answer. Contribution to outsider for scientific research, I want to highlight this because when we do default regime, there's a chance for a silly mistake that we forget to reverse it. So I'll highlight that. Job charges 40A1A 30% that you all were able to answer. Tax was not deducted at source, so we will reverse 30%. The best adjustment of this question was a depreciation adjustment, guys. Subsidy point. So the amount that will enter into the block is after subtracting subsidy. Balance 80% only entered into the block, and they had credited subsidy, guys. So we reversed the credit. We had subtracted it. Okay. Then the severe disability point, you all were able to recall 80DD. Family planning expense, correctly you all told me, allowed only for company assessees. This medium enterprise, of course I will highlight, because medium enterprise 43B will not apply. Instead, on the basis of usual basis of accounting, on the basis of mercantile basis, I allowed the expense. Okay. As per, why did I use mercantile basis, by the way? Did I assume mercantile basis? I didn't assume mercantile basis over here. It was given to me in the question. So that is why I applied the accrual basis of accounting. On that basis, I allowed it. Housing loan was fine. IFHP computation was straightforward. Premature withdrawal was interesting. When you made the FD, it was allowed for you under ATC. That same FD, if you make a premature withdrawal, then the premature withdrawal will be taxable for you under IFOS head. Then in this capital gains adjustment, I would like to highlight the diamond point. Diamond embedded into bracelet became our cost of improvement. The rest of it was fine. One more thing I want to highlight. I'll tell you one more silly mistake which is possible from student point of view. In default regime, when you do tax liability, many students will directly end up doing basic tax on 26,88,000. Are you able to relate with what I'm telling you? Inside this 26,88,000, actually, there is LTCG of 4,10,000. That we might forget when we come to default regime. That is why I always tell students, how many ever columns you are having in normal regime, no. That many columns you will have in default regime also. In normal regime, you are having 2 columns over here for normal income and 112 LTCG. So if you learn like that, you will remember to have one control. This is what you learn in audit, right? That wherever a fraud is possible, in all those places you will try to insert a control. In audit, that's what you learn. So same thing even over here, have this control in your mind that how many ever columns you have for tax computation in normal regime, same number of columns you will have in default regime also. That will help you to ensure to check that, okay, fine, we have to do 2 columns. Even over here we have 112 LTCG. So my total tax in the default regime is 3,33,580. My total tax in the normal regime is 394,320. In normal regime, I did not think about AMT because assessee did not have 10 AA. Chapter 6A Part C 35 AD assessee didn't have. So therefore, I did not think about AMT. Alright guys, can I close this question? Can I take you forward? So we are now starting with question number 4. This is mock test paper 2 of your May 26 exam. This is a nice question with regards to clubbing, guys. Clubbing and little bit of PGPP mixed. The question says Mr. Ramesh makes a gift of 25,000 to his wife Rani. Okay. So we have Ramesh. He is gifting 25,000 to his wife Rani. When did the gift happen? On 27th March 2025. Okay. Mrs. Rani on 1st April 25 invested 1,25,000 out of gift and 75,000 of her own in a partnership firm as capital, which is a total capital contribution in the firm. So wife Rani has put 1 lakh capital contribution in a partnership firm. How did she get this 1 lakh? This 1 lakh is nothing but this 25,000 which she got from Ramesh, that 25,000 plus her own 75,000 she's put into partnership firm. Now, can I say that the transferred asset originally was 25,000 cash? Come on guys, clubbing concept. Ramesh had given 25,000 to spouse for no consideration or inadequate consideration. So you can say transferred asset is 25,000. This transferred asset has changed form into what? This transferred asset has changed form. This 25,000 cash has changed form into capital contribution into partnership firm. Okay. So from this capital contribution, what income will you earn? From this capital contribution, you will earn interest income. So whatever interest income is earned from this capital contribution will be clubbed with Ramesh's income. Okay. Now see what does the question say. During the year ended 31st March 26, she earns interest 15,000. 15,000 total interest she is earning from this capital contribution, and she is also getting salary 1,20,000 from the firm, both of which are approved by the partnership deed. Answer my question. Step by step we will go. Question number 1. Will the salary be clubbed with Ramesh's income? No guys, only income from transferred asset in same form or different form will be clubbed. From capital contribution, what income she will be earning? Interest income. So only interest income will be clubbed, salary income will not be clubbed. Then comes question number 2. Interest, how much will be clubbed? I'll always go step by step. I'm not sure if you remember, but I've always taught you this, that you always first do the computation in the hands of the person who's earned the income, only the computed number you club. Do you know this? Whenever clubbing concept applies, you first do the computation in the hands of the person who's earned the income, find the taxable income in her hands, then only you club. See guys, she got 15,000 interest. From how much capital? From 1 lakh capital, she got 15,000 interest. Which means 15,000 by 1 lakh into 100. What percentage interest she's getting, guys? 15% interest she's getting. But tell me, interest on capital, how much is going to be taxable for the partner? Whatever is allowed for the firm. For the firm, 12% will be allowed. So for partner also, what will be the total taxable income? The taxable income will be 12% only. So 1 lakh is a capital contribution. This into 12%. 12,000, this only will be the taxable interest. First of all, do you agree? Yes, total interest income she is getting 15,000 on 1 lakh capital contribution, which means she is getting 15,000 interest income, guys. But how much is taxable interest? Whatever is allowed for the firm only will be taxable for the partner. Maximum for the firm, how much will be allowed? 12% only will be allowed maximum for the firm. So how much will be taxable for the partner? Even though she is getting 15%, 12% only is taxable. So 12,000 only is taxable. Point number 1. Then comes point number 2. Out of this 12,000, how much will be clubbed with Ramesh's income and how much will be taxed as Rani's own income? Formula you have, guys. Do you remember? When the transferred asset changes form into investment in business, or when the transferred asset changes form into capital contribution in partnership firm, you apply formula, no? Which formula? That formula, guys, when numerator denominator has to be on 1st April of the previous year. That formula I will apply. So, tell me, what's the income? Income into investment out of transferred asset on 1st April of the previous year divided by total investment on 1st April of the previous year. What's the income? 12,000. What is the investment out of transferred asset? 25,000. What's the total investment? Total capital contribution? 1 lakh. So how much is going to be clubbed with Ramesh's income? I'm getting 3,000. This is what will be clubbed with Ramesh's income. So what's the balance income which will be taxed as Rani's own income? 12,000 minus 3,000. Balance 9,000 will be taxed as Rani's own income. What are they asking us? What amount will form part of total income of Mr. Ramesh? So how much has to be clubbed with Mr. Ramesh? 3,000 only. Answer is option A. Okay, you got the point. So I'll tell you what is our trick over here. I'll tell you what is the twist over here. I'll tell you why I wanted to solve this question for you. There are 2 reasons. Reason number 1, will salary be clubbed? Reason number 1, salary will not be clubbed. Only income from the transferred asset will be clubbed. Transferred asset has changed form into capital contribution. From capital contribution, what will you earn? Interest. So interest only will be clubbed. That's the first learning. Second learning, many students, what they will do is, they will straight away do, 15,000 is interest income. 15,000 into 25 by 1 lakh they will do. You shouldn't do that. You have to first find the taxable interest income. Total interest is 15%, but only 12% will be taxable. So only 12% is taxable interest. This is what you will split between Ramesh and Rani. Alright guys, formula and all you know very well. The point that you have to be very careful about is, you can't split 15,000 into Ramesh and Rani. You have to apply section 40B. You have to find what is taxable income. That is what you will split between 2. Okay, so this was your question number 4, guys. Can I take you forward to our next question, please? Come on, come to question number 5 now. Question number 5 says, Mrs. Reshma, an Indian citizen, is government employee working for Indian government. Does something come to your mind? Indian citizen, government employee, working for Indian government, something is coming to your mind. I'll tell you what is coming to your mind. I'll tell you what is coming to my mind. If assessee is an Indian citizen, if employer happens to be government of India, even if the employee is rendering services outside India, still the salary income will accrue in India. This is what is coming to my mind. Are you able to recall this provision? Yes guys, Indian citizen, employer is government of India, and this person is rendering services outside India. Even though he is rendering services outside India, whatever salary income he gets, it accrues in India. Listen to me now. Salary income, allowances, perquisites, everything will accrue where? Everything will accrue in India, in India, in India. After accruing in India, salary alone will be taxable. Allowances and perquisites will be exempt. Are you aware of this point? So in this situation, salary, allowances, perquisites, everything will accrue in India. After accruing in India, salary alone will be taxable. Allowances and perquisite will be exempt for this person. Okay. Now come to the question. Mrs. Reshma, Indian citizen. So condition number 1, she's an Indian citizen. Then she's a government employee. So employer is Government of India. First two conditions are fulfilled. She is working for the Indian government. She submits the following information. A lot of information is given to us. Determine the gross total income of Reshma ignoring 115 BSc, which means which regime? Which means normal regime we have to compute on the assumption that she is resident but not ordinary resident and non-resident. So basically, typical residential status question, guys. What if assessee is RNOR? What if assessee is NR? Total income we have to find. Are you ready? Come on. Come to the first adjustment. First adjustment. Salary income received in Malaysia for services rendered over there. Where is the salary income going to accrue? Assessee is Indian citizen. Employer is Government of India. Assessee is rendering service in Malaysia. Service is rendered outside India. All my conditions are fulfilled, guys. So even though the services are rendered in Malaysia, still where will this income accrue? This income will accrue in India. Because this income is accruing in India, what kind of income will this become? This will become Indian income, and because it is Indian income, it will be taxable for whom? It will be taxable for all. Easy peasy. Come on, salary income. I'll tax it for everybody. 2 lakh, 2 lakh. Can you please try to identify one terrible mistake I've done over here? Salary income received. Did they use the word computed? No. Did they say income from salaries? No. So don't you think I should subtract something? I should subtract my section 16 deduction, my standard deduction of 50,000. I should be subtracting the balance. 1,50,000 only will be taxable. Ma'am, why 50,000? Why not 75,000? Question says, guys, normal regime, that's why. Okay, then profit from business carried on in Orissa. Business is carried on in Orissa. So where is the source of income? Orissa, in India. Therefore, it becomes Indian income. Therefore, it will become taxable for all. So we have business income 80,000. 80,000. Okay. Then profit from business carried on in Paris. So where's the source of income? Business in Paris. Sources outside India. Income is earned and received in Sydney, and business is controlled from Paris. So source is outside India. Received is also outside India. Even the business is controlled from outside India. So this becomes a foreign income. Will this income be taxable for your RNOR? Paris business. Not taxable for RNOR, not taxable for NR, not taxable for anybody. It's a foreign income. Then comes your fourth adjustment. Loss. Loss from business carried on in Canada. So where's the source of this loss? Outside India. Profits are not received in India. So which means received also outside India. But business is controlled from Dehradun. This controlled point is relevant for whom? Controlled point. Business income from business controlled in India. Relevant only for RNOR. So step by step if I go, I'm having loss of 46,000. Okay. And this loss is from business outside India. Received also outside India. But however, it is a business which is controlled in India. So for RNOR I will consider. But it's a loss. So what do I do with losses? I put losses in the margin. I handle them later. So I'm having business loss of 46,000. I will consider for RNOR. But what about NR? Will I consider this for NR, guys? For NR, I don't care about where the business is controlled from. Source is outside India. Received also outside India. For NR, I will not consider. Okay. Then, unabsorbed depreciation of business in Canada. Same Canada business, unabsorbed depreciation 16,000. I'll consider for RNOR 16,000. Why am I considering for RNOR? Because for RNOR we decided, right? Controlled in India. Because controlled in India we will consider for RNOR. So business loss also we will consider. Unabsorbed depreciation also we will consider for RNOR. Then profit from Indonesia business. Controlled from Delhi. 60% of the profit deposited in a bank in Indonesia. 40% received in India. Go step by step. Tell me about RNOR. What should I do for RNOR? Indonesia business. So the source is outside India. But the business is controlled from Delhi, guys. Business income is controlled in India. The business is controlled in India. So for RNOR, you will consider. So I'm having Indonesia business. For RNOR, you will consider 70,000 rupees. Okay. What about NR? NR, only Indian income you will consider. This income, if you see, it is from Indonesia business. So the source is outside India. 40% is received in India. So 40% will become 28,000. That alone is received in India. That alone will become Indian income. So 28,000 alone you will take for non-resident. Right guys? For non-resident we consider only Indian income. I'll repeat one last time. Where is the business controlled from? Is that relevant for non-resident? No. Where is the business controlled from? Is that relevant for non-resident? No. It's relevant for whom? Only for RNOR. That's the only reason why I'm doing this question. Just wanted to remind you that point. Okay guys, that's it. So come on, I have to adjust this business loss. Can I adjust this business loss against salaries income? You can't adjust against salaries income, but you can adjust against business incomes. So against my business incomes, I'll adjust the loss of 46,000. Also this unabsorbed depreciation, I'll adjust against business income. So what's your net income now for RNOR? RNOR net income is 2,38,000. The loss I have adjusted only against business income. For NR, the total income is 2,58,000. Please check whether your number and my number is matching. Yes guys, so this question was good. Number one, it gave us a reminder of this particular point. Assessee is an Indian citizen, employed is Government of India. Even though he is rendering services in Malaysia, still the salary income is accruing in India. First reminder for us. Second big reminder, where is the business controlled from? That point is relevant only for RNOR, not relevant for NR. Okay, this was your question number 5. Can I take you forward please? So I'm now starting with question number 6. Question number 6 is again a mock test paper question, but it's a pure capital gains question guys, and a little bit of CGT account will also get covered for you over here. The question says, Mr. Arjun, a resident individual aged 58 years. So what would you like to conclude at this stage? Mr. Arjun, you are not a senior citizen. Alright, he's not a senior citizen. Then he's selling unlisted shares in a private company. So we're talking about unlisted shares. He's selling on 17th May 25. This becomes his date of transfer. He's selling for 10 lakh. This becomes his full value consideration. Shares were bought on 1st August 2012. This becomes the date of acquisition. They were bought for a consideration of 2 lakhs. So 2 lakhs will become his cost of acquisition. Then Arjun paid 2,000 as brokerage. 2,000 brokerage on sale of shares. This will become expense on transfer. Okay. Then Mr. Arjun deposited 5 lakhs in capital gains account scheme on 15th June 26 before filing return of income. Then on 30th April 27, he withdraws 4,50,000 and purchases a residential house property at Delhi on 1st May 27 for 4,50,000. CII numbers I have given to you. They're asking you to find capital gains. Are you ready? Can I begin? We'll first do the basic capital gains calculation. CGT point and all, we'll come to it later. So what are we transferring guys? What's my capital asset transferred? Shares. Give me more clarity. What kind of shares? Unlisted shares. We're transferring unlisted shares. Then what's the period of holding? Check the question. When did we buy the shares? Date of acquisition. See here, date of acquisition is what? 1st August 2012. And when are we transferring the shares? Date of transfer? Date of transfer is 17th May 2025. Tell me, are we transferring before the amendment or after the amendment? We are clearly transferring on or after 23rd July 24. We are transferring after the amendment. So what's the relevant period of holding? Unlisted shares. Relevant period of holding will be 24 months. Am I holding the shares for more than 24 months guys? Yes, I am holding them for more than 24 months. Therefore, it will become long-term capital asset. Will 112A apply here? Only if it is listed equity shares, 112A will apply. This is unlisted shares, so therefore 112 only will apply. Okay, then I'll start with my computation everybody. My first step in the computation is full value consideration. What's a full value consideration? See here. 10 lakh rupees minus expense on transfer. I do have expense on transfer, 2,000 rupees. So the balance 9,98,000 rupees. This becomes my net consideration. Then less cost of acquisition. Can I please index the cost of acquisition? Transfer is after amendment, no indexation. Will you apply grandfather clause? Grandfather clause is that FMV on 31st Jan 2018. Will you do all that? All that you will do only if it is 112A. This is 112. So I'll take the cost of acquisition as it is. What's your cost of acquisition over here? See, cost of acquisition is 2 lakh rupees. No cost of improvement. Easy. What's your LTCG? 7,98,000. Till here, is it making sense to you? Till here, there's no complication, there's no rocket science till here. Pretty simple. Now listen, guys. This is where the game begins after this step. The assessee, what has the assessee done? Assessee has deposited 5 lakh rupees in capital gains account. Assessee has deposited this money on 15th June, which is before filing ITR. Good. If you are depositing money in CGT, you should deposit before the ITR date only. And good thing, assessee has deposited before ITR. That is good. What is the amount? 5 lakhs. Okay. Now, why is assessee depositing money in CGT account? What exemption does he want, guys? Later, he is withdrawing money and he is purchasing a residential house. So, he is purchasing a residential house. So, which section exemption is possible? If you purchase a residential house, 2 sections exemptions are possible, guys. It can either be section 54 or it can be 54F. But 54 will come into the picture if you sell a house and buy a house. Are you selling a house over here? You are not selling a house. So 54 will not come into the picture. 54F will come into the picture if you sell any long-term capital asset other than residential house property and if you buy a residential house property. That's exactly what my assessee is doing. He's selling some long-term capital asset other than house and he's buying a residential house. 54F is what will come into the picture. 54F, F for what? F for formula. So what's your 54F formula? Tell me first. 54F formula is amount invested into LTCG by net consideration. How much amount have you invested? I will take the CGD amount first. See, I'll tell you why. I will not straight away take 4,50,000 because 4,50,000 assessee has purchased only in 2027, guys. Only after ITR date only assessee has purchased the new house. So therefore, when assessee is filing ITR, that time we don't know how much money assessee is going to be putting in the new house. So I will take the CGD money. How much money he put in CGD? 5 lakh into what is the LTCG? 7,98,000 by net consideration 9,98,000. So what's a 54F exemption? One weird number I'm getting. 3,99,800. I'll round it off. Did you understand? Will you listen to me once again? See, what's my current year? 25-26. Listen to me, okay? 2 minutes, listen to me. Current year is 25-26. What are the 139 dates possible for me? 139 date possible for me is either 31st July 26 or 31st October 26 or 30th November 26. These are my possible 139 dates. Please see, when am I buying the new house? I am buying the new house only on 30th April 2027. So you yourself tell me, when I am filing my ITR that time, do I know how much money I am going to be putting in the new house? No, right. I am putting money in the new house only on 30th April 27. Only after ITR date only I am putting the money in the new house. So when I am filing the ITR, that time we don't know how much assessee is going to invest in the new house. So that time we don't know about the 4,50,000 number. What is the only number we know about? We only know that assessee has put in CGD account how much? 5 lakh rupees. That is why I am taking 5 lakh rupees only. Is everybody crystal clear? You know why I am telling you this? Because if assessee had purchased the new house within 139 date, like over here, had assessee purchased a new house on 30th April 26, that is if assessee had purchased a new house before filing the return, then tell me, would you consider the CGD number? Then you will not consider the CGD number, right? It's very logical. When you're filing ITR, that time if you know how much you're investing in the new house, then you will straight away take the new house number. But in this question, I'm buying the new house only in 2027. That is after my ITR dates. So when I'm filing the ITR, I don't know how much I'm going to be investing in the new house. So therefore, I will take the CGD number. CGD number is 5 lakh rupees over here. So 5 lakh into LTCG by net consideration, 399,800. So what will be your taxable LTCG now? Taxable LTCG is going to be 3,98,200. This is taxable in which year? Current year 25-26. Assessment year 26-27. Okay guys, but listen, the story is not over. How much money you put into CGD? You put 5 lakh rupees in CGD. But how much do you utilize? Only 4 lakh 50 you utilized. So don't you think you have enjoyed extra exemption? 5 lakh rupees you put in CGD. On that basis I gave you exemption. But you have actually utilized only 4 lakh 50. So now I will reverse the exemption. Listen to me now. Tell me, which section are we talking about? I'll explain the whole story to you. Which section are we talking about? 54F. Okay. Now in 54F, when are you supposed to buy the new house? Within 2 years from the date of transfer, or if you're constructing, you must construct within 3 years from the date of transfer. So 2 time limits you have over here. 2 years, 3 years, 2 time limits you have over here. So when will you revisit the CGD account? After 3 years, guys. 3 years after the date of transfer. So here your date of transfer is 17th May 2025 plus 3 years is what? 17th May 2028. That is when you will come back into the CGD account. When you come back to CGD account, how much money you will still find in CGD account? You had put 5 lakh rupees initially, but how much you utilized? You utilized only 4 lakh 50. So how much money will you still find in CGD account? 50,000 rupees you will still find in CGD account. Now this 50,000 rupees, there will be some reversal. How will you find the reversal? Very simple. Tell me. Actually, how much you utilized? Only 4 lakh 50. So 4 lakh 50 into LTCG by net consideration. LTCG is 7 lakh 98,000 by net consideration 9 lakh 98,000. How much are you getting? You will get 35, 98, 20. This is the exemption which you should have enjoyed, guys, because actually you spent only 4 lakh 50. So this much exemption only you should have enjoyed. But how much exemption you enjoyed? You enjoyed 399,800 exemption you enjoyed. So how much extra exemption you enjoyed? 399,800 minus 359,800. The extra exemption of 39,980. This is extra exemption that you have enjoyed. I will reverse this exemption. Reverse this exemption means what? Reverse this exemption means I will tax this as LTCG. I will tax it in which year, guys? When are we revisiting? In previous year 28-29. In assessment year 29-30. 39,980 will become your taxable LTCG. So my final answer. What is capital gains taxable in 26-27? Current year 398,200 is taxable. Then what's the tax treatment with mention of assessment year of the unutilized amount? Unutilized amount is actually 50,000, but how much will be taxable for you in that? 39,980 will be taxable for you. In which year will it be taxable for you? In previous year 28-29, assessment year 29-30. I am not expecting you to understand this entirely right now, but can you tell me at least 10%, 15%, did you understand at least in which direction I am taking you? Yes. Then I will re-explain the whole thing to you once again. You would have understood this entire thing in bits and pieces. Okay. So I'll just give you one quick understanding of this entire thing once again. We'll go step by step. According to me, till here you should have understood already that how I calculated this number. This was nothing big, guys. I was putting money in CGD account. So therefore, I enjoyed 54F exemption. Why 54F exemption? Because SSE sold shares and he bought a house. Had he sold a house and bought a house, you would have thought about section 54. Here SSE did not sell house. He sold some other long-term capital asset and he bought a house. Therefore, of course, I will think about 54F. And 54F, F for formula. So we always put the formula amount invested into LTCG by net consideration. Here, in amount invested, why I did not consider 4 lakh 50? Because we purchased the new house only in 2027. Only after filing ITR. You're getting the logic. When I'm filing ITR, do I know how much money I'm going to be putting in the new house? I don't know, guys. So therefore, that when I'm filing the ITR, 450 number will become irrelevant for me. So what money I put into CGD? 5 lakhs. On the basis of 5 lakhs, I will enjoy exemption. How much exemption I enjoyed? 399,800 exemption I enjoyed. Now you tell me, just putting money in capital gains account, is it enough? No, right? After putting the money, I also have to utilize the money. I have to utilize the money to buy the house. So I put the money, 5 lakh rupees money I put in CGD account. Okay. All my time limits are from the date of transfer. My date of transfer is 17th May 25. We will revisit the CGD account after 3 years. So we will revisit on 17th May 28. When we revisit on this day, tell me how much money we will still find in the account, guys. Only 4,50,000 we utilized. 50,000 we will still find in the account. Now this 50,000 as it is, you can't tax it as LTCG because even earlier you applied formula, right? So now also you have to apply formula. So what I did is, I first calculated the correct amount of exemption. That actually my assessee has invested 4,50,000 only. So 4,50,000 into LTCG by net consideration. This is the correct amount of exemption which my assessee should have enjoyed. Then I saw how much assessee has actually enjoyed. Actually, my assessee has enjoyed 399,800. So extra assessee has enjoyed. You should have enjoyed only 359,820, but you enjoyed 399,800. So what was the difference? The difference of 39,980. This I will tax it as LTCG. But this will be LTCG for you which year? When are you doing all this calculation? When are you revisiting the capital gains account? On 17th May 28, right? 17th May 28 is which previous year? Previous year 28-29, assessment at 29-30. So in this year, 39,980 will become your LTCG. Now did you understand? So whatever gap you had in your understanding, this second explanation should have made things more bearable for you. Right guys, can I close this question now? Can I take you forward? Yes, 54F. I really wanted to give you a reminder and I'm glad we were able to do this question. Now come to question number 7. One more capital gains question and this is going to be slum sale. Slum sale is something I really wanted to do one question for you. The reason being, it's been a very long time since they've actually tested slum sale in the exam. Last they asked slum sale in Jan 2025 only. After that, they've never asked slum sale and I found an amazing question in your first mock test paper. So we're going to do that, guys. Okay. Every bit of slum sale will get revised for you through this question. The question says Mr. Shivam is proprietor of Star Stores having 2 units. On 1st April 25, he transferred unit 2. There are 2 units. Only unit 2 he is transferring, which he started in 2014-15. This will become the date of acquisition. When is he transferring? 1st April 25 he is transferring. This will become the date of transfer. What is he transferring? There are 2 units, but he is transferring only unit 2. Okay. By way of slum sale, total consideration is 18 lakhs. But do you know, in slum sale cases, what is full value consideration? Full value consideration is FMV of consideration that we are receiving or FMV of the asset that we are transferring, whichever is higher. That is FVC, keep in mind. So what's the consideration we are receiving? We are receiving 18 lakh rupees. We'll wait and see what is the FMV of asset we are transferring. Then only we will finalize FVC number. Balance sheet is given to us. Is unit 1 relevant for me? Unit 1 is not relevant for me, guys. Unit 2 only we are transferring. Okay. Then some adjustments they have given to us. They are asking us to compute capital gains for assessment at 26-27. Are you ready? Yes guys, come on, let's begin. My usual process. What's my capital asset transferred? We are transferring unit 2 by way of slum sale. Then what's your period of holding? When did we start this unit, guys? We started this unit in 2014-15. Okay. And when are we transferring? See, we are transferring on 1st April 2025. Are we transferring after the amendment? Yes, my transfer is on or after 23rd July 24. But can you please tell me what will the relevant period of holding be? After amendment, we have only 2 periods of holding, 12 months and 24 months. We don't have 36 months, but for slum sale, we continue to have 36 months. Right guys? For slum sale, whether before amendment, whether after amendment, it is always 36 months only. Is this period more than 36 months? Yes, it is clearly more than 36 months. So can I say this is long-term capital asset? Can I please apply 112A? No, terrible. 112A is only for listed equity shares. This is slum sale. This will be 112 LTCG. Okay guys, now come on. Full value consideration. Have I finalized full value consideration number till now? No, I still need FMV of asset transferred. I don't know the full value consideration right now. I'll keep it pending. Less expense on transfer. See, the question says professional fees and brokerage paid for this transfer is 78,000. So this is my expense on transfer, 78,000. So I'll get my net consideration. less cost of acquisition, cost of improvement, we'll get our LTCG. Now, in slum sale, what's the most important calculation? Your cost of acquisition, cost of improvement. This will be nothing but your net worth, guys, net worth. So come on, let's do proper net worth computation. Working note number 1, net worth. How to find net worth? Asset minus liability. So step by step we will go. They have given lot of adjustments also over here. We'll do them all one by one. The first adjustment is for land. So for land we have an adjustment, the first adjustment. Then second adjustment says no individual value is considered in the transfer deed. Okay. Then patents. So for patents also we have an adjustment, third adjustment. Then furniture. Furniture also we have an adjustment, fourth adjustment. Then fair market value of capital asset transferred. What is this? FMV of capital asset transferred. Remember, for full value consideration, I wanted FMV of asset transferred. That they have given me. FMV of asset transferred is how much? It is 18,10,000. So now can you tell me what is the FVC? FVC will be whatever I am receiving or whatever I am transferring, whichever is higher, which is higher over here. 18,10,000. So 18,10,000 is my full value consideration. Minus 78,000 net expenses, my net consideration will be 17,32,000. Now come, my full focus will be on net worth computation. Come on guys, first asset, land. For land, we have adjustment number 1. Land of unit 2 was purchased at 5 lakhs. So what's the real cost? 5 lakhs. And it was revalued at 7 lakh 50. So 7 lakh 50 revalued number I'm having in the balance sheet. Which number will I take, guys? Come on. In slum sale, we always take the number before revaluation. So instead of 7 lakh 50, I will take 5 lakhs. The real cost only I will take. Easy this was. Then comes furniture. So for furniture, we have an adjustment. We have adjustment number 4. So furniture of unit 2 of 5 lakh rupees. Okay, furniture 5 lakh rupees. About that they are saying something. It was purchased on 1st December 24. 1st December 24 means which year? It was purchased in previous year 24-25. Last year it was purchased, on which no depreciation has been provided. So what will we do? Okay, we will now give depreciation. So furniture, see, we purchased it for how much? For 5 lakh rupees. When did we purchase it? Last year we purchased, and they are saying we never gave depreciation. So I'll give depreciation now. Depreciation for 24-25. How much will it be? Tell me, carefully tell me. At what rate? Furniture, I purchased furniture for 5 lakh rupees. For 24-25, I want to find depreciation. 5 lakh rupees into 10% into, it was purchased on 1st December 24, guys. So don't you think in 24-25, you have put the furniture to use for less than 180 days in 24-25. So in 24-25, you will get only half year's depreciation. So in 24-25, what will be your depreciation? 25,000, everybody. Are you getting this number? Now, will I do current year depreciation also? No, guys. Current year we are transferring. Current year slum sale is happening, right? Current year transfer is happening. Tell me, in income tax, do we have proportionate calculation of depreciation? Like 3 months, 4 months, do we have like that? No, right? In income tax, depreciation is year-end exercise. Year-end only you do depreciation calculation. In our current question, we are doing slum sale in the current year. So in the current year, there will be no depreciation calculation. Only till 24-25 I will calculate, because depreciation is only year-end exercise. So for furniture, what's a WDV I should take? I should take 4,75,000. This was simple. Then debtors. For debtors, there is no adjustment. So I'll take 3,50,000 as it is, whatever they have given me. Debtors, 3,50,000. Then patent. For patent, we have an adjustment. We have already identified adjustment number 3. So patent is 7,25,000. Let's see what they are saying. Patent was acquired on 1st December 23. Which year was it acquired, guys? 1st December 23 means it was acquired in 23-24, on which no depreciation was provided. Okay, I will now provide depreciation. Patent, intangible asset. What's a depreciation rate? 25%. Now don't say, ma'am, intangible asset and all, no depreciation. Is it like that? only goodwill no depreciation. Other intangible asset you still get 25% depreciation. So tell me, you purchased the patent for how much? Patent is for 7,25,000 rupees. You purchased it when? On 1st December 23. Since then you did not give depreciation. So what's your depreciation for 23-24? How will you calculate? You purchased it for 7,25,000. What's the depreciation rate? 25%. This one also you purchased on 1st December, guys. 1st December means in 23-24 you would have put the asset to use for less than 180 days. So in 23-24 how much depreciation you will get? Only half year's depreciation you will get. So 7,25,000 into 25% by 2, 90625. This will be 23-24's depreciation. So what's your net number? 634,375 will be your net number. Then you will calculate depreciation for 24-25 also. Ma'am, why we did not do 2 years depreciation here? Because furniture we acquired in 24-25, guys. So only 24-25 depreciation was required. But patent is 23-24. So here I'll have to do 23-24 depreciation also, 24-25 depreciation also. So 24-25 WDV basis, guys. So 634,375 into 25%. How much will that be? That is 1,58,594. So what's your net number? 4,75,781. Same question I will ask you. Will I do current year's depreciation? No. Depreciation is year-end exercise. Current year you are transferring the unit. So current year there will be no depreciation. This is also done. Okay. So with this, guys, I'm done with the asset side. Now let's come to the liability side. Capital, will I do anything? No. Revaluation reserve? No. Bank loan 8,50,000. 70% is for unit 1. But I need only for unit 2. So unit 2, what will the bank loan be? Total bank loan is 8,50,000. If 70% is for unit 1, for unit 2 it will be 30%. 30% is going to be 2,55,000. Done. Then trade creditors. We need information only for unit 2. Total trade creditors is 4,50,000. 20% is for unit 2. So 4,50,000 into 20%. This is going to be 90,000. Then unsecured loan is 4 lakh. So unsecured loan 4 lakh. 30% is for unit 2. So only 30% I will take, which is 1,20,000. That's all. Can you calculate the net worth for me, please? I am getting 13,35,781. Are you getting the same number? Yes. See, for land, they had given us revalued number. We took the number before revaluation. For furniture, they did not give 1 year's depreciation. So we gave depreciation. Debtor, there was no adjustment. Patent also, they did not give depreciation. So we gave the depreciation. Okay. The liability side was fine. Unit 2 liabilities alone we took. So take this number to your main answer. What's your cost of acquisition, cost of improvement? 13,35,781. That's all. What's your LTCG now? 3,96,219. This will become your LTCG, your section 112 LTCG. Simple. Can I close this? That's all, guys. Yes, so this slum sale question was really crucial because it helped us revise a lot of things. I'll tell you 2-3 points are not covered in this question. I'll tell you that also. With that, slum sale will get completed for you. If any asset was self-generated asset, for example, if we had self-generated goodwill, then for all that you will take what value in net worth calculation? For all that asset you will take 0 value. Then what if in your net worth calculation you had some asset for which you had claimed 35AD deduction earlier? For that asset, which value will you take? For that asset also you will take 0 value. So only 2 extra things are there which are not covered in this question, that if you had self-generated asset, for that asset you would have taken 0 value, and if you had an asset for which you have claimed 35AD deduction, for that asset also you would have taken 0 value. Alright guys, can I close this question? Can we go forward? Yes, come on. Come to question number 8. Question number 8 is a case-based MCQ. 1 second. So come to question number 8. It's a case-based MCQ from your first mock test paper. So they've given us a question over here, a story. And what are they asking us? What is the amount of salary chargeable to tax under the head salaries? So taxable salary we have to find. Deduction available to Mr. Nikhil under chapter 6A. Chapter 6A we have to find. And total income we have to find. That's all guys. So come on, let's read the question and then let's work this out. This is our question number 8. So Mr. Nikhil, a resident aged 42 years. What will you conclude over here? Mr. Nikhil, you are not a senior citizen. He is employed in an MNC in Gurugram since 2013. He submitted his resignation on 31st July for starting his own business and he gave notice period of 1 month. So totally how many months has he worked for guys? He submitted resignation on 31st July. After that 1 month notice period, so he will be working till 31st August 2025 he will be working. So April, May, June, July, August, all my computation for salary will be for how many months? For 5 months. Are you understanding? This is the first light bulb moment in this question. He resigned on 31st July, but he gave notice period of 1 month. So therefore totally he has worked till 31st August. He has worked totally for 5 months. Okay. Then he received the following emoluments from his employer. See, even they are saying from 1st April to 31st August, which means our calculation is correct. They've given us all salary related adjustments over here. Then there's some more adjustment given to us over here. I want to know which regime he's following. Mr. Nikhil is paying tax under default tax regime. Default tax regime means what? My entire computation will be as per 115 BAC. So come on guys, let's do the salary computation. Basic salary. So first of all, salaries computation I'm doing. Basic salary is how much? 45,000. Be careful, how many months? Only 5 months guys. 45,000 into 5, 2,25,000. Then DA. DA forming part of retirement benefit, fully forming part guys, 10% of basic salary. So 2,25,000 into 10%, 22,500. Then medical allowance. Do you know the tax treatment of medical allowance? Medical allowance is fully taxable, 5,000 per month. Medical allowance, telephone allowance, food allowance, lunch allowance, fully taxable. Okay, 5,000 into 5 months, 25,000. Then entertainment allowance, 2,500 per month. Entertainment allowance, you will get section 16 deduction, right guys? But only if assessee is a government employee, and that too only in normal regime. Here assessee is not a government employee, number 1, and number 2 we are not following normal regime. Therefore for entertainment allowance, section 16 deduction I will not get. Alright, so 12,500 is what I am getting. I am fully taxing it. Then commission 10,000 per month. So commission 10,000 into 5, 50,000. This was also easy. Then employees contribution to RPF 7,500. Employees contribution to RPF, in the second question only we had seen this. How many adjustments will come to your mind? Tell me. Same thing what I thought you. Tell me again. How many adjustments will come to your mind? 2 adjustments will come to your mind. 7,500 into 5. Total employees contribution is how much? 37,500. First of all, you will get section 80C deduction. Section 80C 37,500. Then, if employees contribution was more than 2,50,000, if it was more than 2,50,000, you will find the excess. Excess is not taxable. On the excess, whatever is the interest, you would have taxed the interest guys. But is it more than 2,50,000 over here? It is not more than 2,50,000. It is only 37,500. So therefore, this point is not applicable. Only ATC now. ATC 37,500. But guys, my SSE is following which regime? My SSE is following default regime. In default regime and all, will you get ATC? In default regime, you will not get ATC. So therefore, employees contribution, dustbin. Then employers contribution, same amount. Employers contribution, we'll have to do our working note guys. Let's say working note number 1. So working note number 1, employers contribution to RPF. Same steps I will do. How do I do it? What's the first thing I do? Salary. Salary will have three components: basic salary, DA forming part, and employees turnover based commission. What's a basic salary? See, basic salary is 2,25,000. DA, I want DA forming part. The question says it is forming part. It is fully forming part. So I'll take it as it is. Then tell me, can I take this commission, guys? 50,000. I need turnover based commission. Is this turnover based commission? No, guys. It is fixed commission. 10,000 per month. It is fixed commission. It is not turnover based commission. Therefore, I will not take it. So, what's your total number here? Total number will be 247,500. Then tell me, what's your actual employer's contribution? 7,500 per month. How many months? 5 months only. 37,500. Then how much will be exempt? What percentage will be exempt? 12% of salary. 12% is 29,700. Easy, guys. So what's your taxable contribution? Taxable will be received minus exempt. We received 37,500, out of which 29,700 is exempt. So what will be taxable? Your balance 7,800. This will become taxable. But third time I'm doing RPF employer's contribution. Do I ever stop over here? One more thing I always make you check. I make you check whether employer's contribution to RPF plus NPS plus superannuation fund put together, is it more than 7,50,000, guys? How much is employer's contribution over here? Only 37,500. Is it more than 7,50,000? No. Had it been more than 7,50,000, what will you do? Had it been more than 7,50,000, I will find the excess. Excess is taxable. Then I will find interest on the excess. That is also taxable. Here anyways, it is not more than 7. It's not more than 7,50,000. So that drama is not applicable. So what's my taxable number now? 7,800. I'll take it to my main answer. Then interest accrued in RPF, 13% interest is 14,300. Tell me, guys, interest on RPF, what number comes to your mind? How much interest on RPF is exempt? 9.5. We are getting 13. So 13 minus 9.5. How much extra am I getting? I am getting extra 3.5%. That extra 3.5 will be taxable, right? So interest, see, I'll tell you how I'll calculate. 14,300 is 13%. So what is the extra? 3.5%. Simple cross multiplication I will do now. So 14,300 into 3.5 by 13. How much will this be? 3,850. This is the extra interest which I am taxing. Up to 9.5% exempt. Above 9.5%, the excess above 9.5% is taxable. So the excess is 3.5. I found what is 3.5. 3,850. That is taxable. Okay, guys. No other salaries adjustment. Close your salaries head. What's your gross salary? My gross salary is 346,650. Is my number and your number matching? Then minus section 16 deduction. Don't forget 115 BSE. So how much standard deduction? 75,000 standard deduction. So my taxable salary will be 271,650. First question. This was the first question. Taxable salary. So my taxable salary is 271,650. Done, guys. Option A. Can I take you to the second part now? Let's see what else are they saying. This was a salaries discussion. Coming to the second part. In October 25, he started business of manufacturing. As soon as you see manufacturing, what is coming to your mind? Only one thing will come to your mind. Additional depreciation will come to your mind. Okay. He started business of manufacturing of footwear under the brand name Comfort. He withdrew the entire amount from RPF account in September 25. See, guys, when did he join the job? The question says he is working since 2013. 2013 he is working, And right now in 2025 only he is retiring. So can I say that he has worked for at least 5 years? Can I say he has rendered continuous service of at least 5 years? Yes, guys. So because he has rendered continuous service of 5 years, he is withdrawing money from RPF account. RPF withdrawal will be fully exempt for him. Do you know this point? When you withdraw money from RPF, if you have worked continuously for 5 years, after that if you withdraw money from RPF, your withdrawal will be fully exempt, right? My assessee has definitely worked for at least 5 years. Therefore, the entire RPF withdrawal will be exempt only for the assessee. So he withdrew entire amount from RPF in September 25 to invest in business. Okay, that RPF withdrawal is exempt. We have already concluded. Then what happened? Then comes a main adjustment of the question. He employed 75 regular employees. As soon as you see this, something will come to your mind immediately. He is employing regular employees. Immediately, ATJJAA will come to your mind, guys. So he employed 75 employees. On 1st November 25, he employed salary of 23,000 per month and they participate in RPF. ATJJAA. In ATJJAA, you have some conditions, guys. I'll tell you what are the conditions. Condition number 1, assessee must be having PGBP and assessee must be having tax audit. Condition number 2, assessee must be having additional employees, that is new employees assessee must have hired. Condition number 3, how much salary we should pay them? Not more than 25,000 per month. Then condition number 4, in what mode we should pay them salary? Only in specified mode only we should pay them salary. Then condition number 5, these employees must be participating in RPF. They must not be casual employees. They must be participating in RPF. And condition number 6, they must work for us for how many days, guys? They must work for us for at least 240 days in the previous year. But however, if the assessee happens to be in apparel sector, or if the assessee happens to be in footwear sector, or if the assessee happens to be in leather sector, then in that case, 150 days is enough. Do you remember these conditions? Yes, let us check whether these conditions are fulfilled or not. The question says PGBP of the assessee is 51 lakhs. Turnover is 7 crores. 7 crores turnover means definitely for the assessee tax audit will be applicable. I'll tell you why. Question says Mr. Nikhil received 12% of the sales in cash. Listen to me. Section 44AB. Tax audit. See, if assessee's cash receipt is within 5% of turnover and assessee's cash payment is within 5% of turnover, if both the conditions are fulfilled, then if assessee's turnover is more than 10 crore, then only tax audit will apply, guys. Are you aware of this point? If assessee's turnover is within 10 crore, then tax audit will not apply, guys. Yes, you have the special situation. Here the question says, he received 12% of sales in cash. So is cash receipt within 5% of turnover? No. In this question, cash receipt is 12% of turnover. So therefore, will the 10 crore limit apply for us? 10 crore limit will not apply for us, right? See, turnover of the assessee is 7 crores. If the cash receipt was within 5%, like here it is 12%, no, if this 12% was within 5%, then you would have said that, oh, cash receipt is within 5%, cash payment is within 5%, which means 10 crore turnover limit will apply. And oh, turnover is 7 crore only, turnover is within 10 crore, therefore no tax audit. Like that you would have concluded. But over here, the cash receipt is 12%, guys. It is more than 5%. So therefore, this situation is not applicable. So which situation will apply? You will see the turnover. Is it more than 1 crore? Yes, guys. Turnover is more than 1 crore. Therefore, 44AB tax audit will apply. Okay. It is cash receipts and cash payments. Both have to be within 5%. Both have to be within 5%. Then only 10 crore limit will apply. Here, if you see the cash receipt is 12%. So even one of the numbers more than 5%, then 10 crore number will not apply. So 1 crore number will apply. Turnover is more than 1 crore over here. Therefore, tax audit will apply. Condition 1 is fulfilled. then assessee must be having additional employees. Is your assessee having additional employees? Yes guys, new 75 employees we have hired. Is salary within 25,000? Yes. Salary is 23,000 per month over here. Even that is fulfilled. It is within 25,000. Then are we paying them salary in specified mode? See, question is not saying anything. I'll assume salary is paid in specified mode. Then are they participating in RPF? Yes, they are participating in RPF. Then did they work for at least 240 days? 240 days is not required over here. Footwear sector. So 150 days is enough. The employees were hired on 1st November. 1st November means November, December, Jan, Feb, March. 5 months only they worked for us. So 5 months, if I say 30 days every month, total 150 days they have worked for us. So at least 150 days they have worked for us. All my conditions are fulfilled. So do you agree everybody that 80JJAA assessee is eligible for 80JJAA? All the conditions are fulfilled. And my assessee is doing computation in default regime. No, in default regime, 80JJAA you can enjoy. So come on guys, compute now. How many employees? 75 employees. How much salary are you giving them? 23,000 salary you're giving them. For how many months guys? For 5 months, right? For 5 months you're giving them. And what's the percentage of deduction? Do you know that? 80JJAA. How much deduction do you get? Only 30% deduction you get. So 75 into 23,000 into 5 into 30%. 25,87,000. This will become your 80JJAA deduction. So in this question, assessee is following default regime. In chapter 6A, 80C you will not get. 80JJAA you will get. So what is assessee's chapter 6A now? 25,87,000. Option C. Only 80JJAA, no 80C. You got the entire discussion? Yes. And then they are saying, please don't forget assessee is having PGBP of 51 lakh. Okay. Then they are saying he purchased a house property for 90 lakhs for self-occupation. Guys, will I do the hard work over here? Self-occupied property. Default regime. Answer will be 0. He took a loan of 45 lakhs. He paid stamp duty 6,25,000. All this will become irrelevant for me. Assessee is following default regime. So that's it guys. Salary we have computed. Deduction we have computed. Total income, if you see, salaries income is how much? Salaries income is 271,650. Then we are having PGBP. PGBP is 51 lakhs. No other income guys. IFHP we will not compute because self-occupied property in default regime, self-occupied property will be 0. So assessee's GTI will be 53,71,650. Then 80JJAA. How much 80JJAA are we enjoying? Even that we computed already. 25,87,000. So what's your net number? 27,84,650. That's your total income. 27,84,150 it should be. 1 second. 53,71,650 minus, I made a mistake. 1 second. What's your 80JJAA? 75 employees, 23,000, 5 months, 30%. This is where I made a mistake. It should be 25,87,500. So 25,87,500. So you will get 27,84,150. So 27,84,150. Option B will be your answer. Okay. Nice, amazing question. This was. Can I summarize the question for you? And then can I give you one more revision of 44AB? Yes, listen to me. So what's the first thing we learned over here? The first big thing for us in the question was that assessee resigned on 31st July, but he gave 1 month notice period. So because he gave 1 month notice period, we did calculation till 31st August. 5 months we calculated. Salaries computation, you have to agree. Salaries computation was very basic over here. Then after that, when we saw regular employees, that itself gave us a hint that it is 80JJAA. So we computed 80JJAA. In 80JJAA, actually employees should work for us for minimum 240 days in the previous year. But assessee is in the footwear sector, apparel sector, footwear sector, leather sector. 150 days is enough. Okay. Then PGPP they had given to us. IFHP point you were able to identify that because self-occupied property, answer will be 0. So we did not do any hard work. So can I say that if at all you found something tricky in this question, that is the tax audit part. Can I say like that? The rest of the entire thing was okay for you. Salaries computation was okay. Employer's contribution to RPF multiple times we have done till now. So 80GGAA computation part is okay for you. So I can say now, if at all you found something tricky over here, the tricky point will be us identifying tax audit is applicable. Come on guys, can I give you one quick revision of that particular point? Will you listen to me carefully? Will you take it as one final learning? Will you tell yourself that this is the last chance I have? If at all I want to learn, I learn it now. Otherwise, there is no other opportunity for me to learn again. Okay? So listen to me. I'll explain it to you over here. In 44AB, no. For business assessees, when will tax audit apply? If 44AD, what is 44AD? Presumptive taxation. If 44AD presumptive taxation is applicable for the assessee, but whatever PGPP assessee is declaring, it is less than 44AD, which means assessee is not following 44AD, and total income is more than basic exemption limit. If all these conditions are fulfilled, then assessee will have to get tax audit done. Okay. Then second situation, 44AE. What is 44AE? Presumptive taxation for your truck operators, plying, hiring, leasing goods carriages. So if 44AE is applicable for you, but PGPP, which assessee is declaring, is less than 44AE, which means assessee is not following 44AE, then if both these conditions are fulfilled, assessee will have to get tax audit done, guys. Then third situation, if cash receipt of the assessee is within 5% of total turnover and cash payment of the assessee is within 5% of total payments. If both these conditions are fulfilled, then we will enter inside one box. Once we enter inside the box, we will get answer from the box only. If the turnover is within 10 crore, then in that case 44AB tax audit is not applicable. But if turnover is more than 10 crore, then 44AB tax audit will apply. Okay. Last situation, if 1 is not applicable, 2 is not applicable, 3 is not applicable. If none of these 3 is applicable, I will see turnover. If turnover is more than 1 crore, then in that case, 44AB tax audit will apply. Are you understanding till here? The theory is clear for you. Yes, if the theory is clear, then I will start applying this theory in this question, guys. In this question, tell me, assessee's turnover is 7 crores. Is 44AD even possible, guys? In 44AD, your turnover has to be within your turnover has to be within 2 crore or it has to be within 3 crore. Within 2 crore, within 3 crore. But here if you see, turnover is 7 crores, guys. So first of all, do you agree that 44AD chanceless not applicable for the assessee? Is 44AE applicable? Is assessee in truck operating business and all? No, guys. Now come to the third situation. Cash receipt has to be within 5% of total receipt and cash payment has to be within 5% of total payments. Is my cash receipt within 5% of total receipts over here? The question says my assessee's cash receipt is 12%, guys. 12% of the sales was in cash. So is my cash receipt within 5%? No, guys, my cash receipt is 12%. So which means this condition is not fulfilled. Only if both the conditions are fulfilled, then only I will enter inside this dabba, right? But one condition is not fulfilled. So even if one condition is not fulfilled, I will not even enter into this box. Only if I enter into this box, then only you will look at the 10 crore number. But here if you see, is my cash receipt within 5% of total receipt? No, guys, my cash receipt is 12%. It is more than 5%. So therefore this condition is not fulfilled. Only if both are fulfilled, only then you can enter inside the box. One condition is not fulfilled, you can't enter into the box. So even third situation is not applicable for you. Therefore, no choice for me. Which situation will apply for me? Fourth situation will apply for me. In fourth situation, turnover has to be more than 1 crore. Is your turnover more than 1 crore? Yes, guys, it is 7 crores. So therefore, I am falling over here. Therefore, 44AB tax audit is applicable for me. Now do you have the clarity? Whatever doubts you all were having, whatever gaps were there in your understanding, you got it. So this is how you identify 44EB. You go step by step. You see which bucket assessee is falling under. According to that you answer. Okay, they're trying to confuse us over here with the 10 crore number, but we have to be stubborn with our concept. I will apply the 10 crore number only if both the conditions are fulfilled, but here one condition is not fulfilled, therefore 10 crore number will not apply. Okay guys, that's it with this question. Can I take you to question number 9 now? Come on, the last two questions left. Question number 9 is a small residential status question, and question number 10 is a small tedious question. Two tiny questions. If you wanted to give up, you should have given up long back. If you're here with me till now, now is not the time to give up then. Come on guys, come to question number 9. The question says, who among the following will qualify as resident? Are they asking for residential status of each person? No. They're asking who will qualify as resident. So we just have to say resident or non-resident. I don't have to say ROR, RNOR, all that I don't have to say. I just have to say whether resident or non-resident. So it's an MCQ question, okay? Who among the following will qualify as resident? Mr. Pop, an Italian singer, came on a visit to India. Are you noticing? He is visiting India to explore Indian classic singing on 15 September 25. He left on 1st December 25. How many days has he lived in India, guys? In September, he came on 15 September. So 30 minus 15 plus 1. This is how many days he stayed in September, October, November, 1st December he is leaving. So totally how many days has he lived in India? 78 days he has lived in India. Okay. Then past 4 years, he visited India for singing competition and stayed in India for 120 days each year. So if I'll write over here, Mr. Pop, in previous year he has stayed in India for 78 days. And in 4 preceding previous years, question is saying 4 years he came to India for 120 days every year. So last 4 years he stayed in India for 480 days. Are you ready? Can we sing our residential status song, guys? Come on, tell me. Is your assessee an Indian citizen visiting India in the previous year and total income minus income from foreign sources is more than 15 lakhs? See, he is visiting India in the previous year. But is he an Indian citizen, guys? No, he's an Italian singer. So therefore, can I say that the special provision will not apply over here? If you don't know what is special provision, you have one provision where 60 days and 365 days is there. You have one provision where you have 120 days and 365 days. No, that 120 days, 365 days, that provision I call as special provision. Now you're understanding. There is one provision where in basic condition 2, it is 60 days and 365 days. There is one more provision where in basic condition 2, you have 120 days and 365 days. The one where you have 120 days and 365 days, no, that I am calling a special provision. That special provision you can apply only if assessee is Indian citizen, visiting India in the previous year, and Indian income is more than 15 lakh. Here assessee is not an Indian citizen, not a person of Indian origin. Therefore, that special provision will not apply. So what will apply now? My regular provision will apply. What does regular provision say? In basic condition 1, in previous year you must stay in India for at least 182 days. Did he stay in India for 182 days in previous year? No. Then basic condition 2, you will pause, check, think, tell me, is your assessee an Indian citizen who is leaving India as a crew member of an Indian ship? No. Is your assessee an Indian citizen leaving India in the previous year for employment outside India? No. Is your assessee an Indian citizen or person of Indian origin who is visiting India in the previous year? He is visiting India, but he is not Indian citizen. He is not person of Indian origin. None of the 3 situations are applicable, which means basic condition 2 will apply over here. Basic condition 2 says, previous year you must be in India for at least 60 days. 4 preceding previous years you must be in India for at least 365 days. Fulfilled or not? Definitely fulfilled, guys. Previous year 78 days, at least 60 days. 4 preceding previous years 480 days, at least 365 days. Definitely fulfilled. Basic condition 2 is fulfilled. So what does your assessee become? Anyone basic condition fulfilled, assessee becomes a resident. Will I do the hard work of checking whether ROR or RNOR? They did not ask me residential status. They are just asking, will he qualify as resident or not? Yes, he will qualify as resident. Mr. Pop is a resident. Okay, guys. So, which means, can I say here itself, option B can't be the answer, option D can't be the answer, option B doesn't have pop, option D saying none of the three. So, it can either be option A or it can be option C. Now, come to Mr. Abhishek, the second person. Abhishek. What are they saying about him now? He was born and settled in Canada. He visits India each year for 100 days. 100 days is coming to India to meet his parents and grandparents born in India. So, what will you call Mr. Abhishek? His parents and grandparents are born in India. Abhishek becomes person of Indian origin, guys. He's born in India in 1946, living in Delhi. His Indian incomes are 15 lakh 20. Come on, guys, let's check. Will I apply the special provision over here? Is your assessee an Indian citizen or person of Indian origin? Is he visiting India in the previous year? And his total income minus income from foreign sources, that is income from Indian sources, is it more than 15 lakhs? Let us check, guys. He is a person of Indian origin. Condition 1 fulfilled. Is he visiting India? Yes, guys, he is visiting India for 100 days. He is visiting India, no? He is visiting India for 100 days to meet his parents. And total income minus income from foreign sources, that is income from Indian sources, is it more than 15 lakhs? His Indian income is 15 lakh 20, more than 15 lakhs. All the conditions are fulfilled. So can I say special provision will apply over here? In special provision, basic condition 1, in previous year you must be in India for at least 182 days. Fulfilled, guys? Not fulfilled. He is in India for only 100 days. So basic condition 1, not fulfilled. Basic condition 2 says, previous year he must be in India for at least 120 days. For preceding previous years, he must be in India for at least 365 days. 120 days, guys, not 60 days here. He is visiting India. Income is more than 15 lakhs. He is person of Indian origin. So 120 days limit you will apply. No, not 60 days. So is he in India for 120 days in the previous year? Only 100 days, guys. So this will not be fulfilled. Basic condition 1 also not fulfilled. Basic condition 2 also is not fulfilled. So what will you call your assessee? You will call your assessee as non-resident. Now, if he is a non-resident, do you close your answer over there? You don't close your answer over there. If he is a non-resident, you check whether he is deemed resident or not. Deemed resident, how many conditions you have? 4 conditions you have. Condition number 1, assessee must be an Indian citizen. Condition number 2, he must be a non-resident. Condition number 3, his total income minus income from foreign sources should be more than 15 lakhs. And condition number 4, he is not liable to pay tax in any other country. Is he an Indian citizen? He is born and settled in Canada. Is he an Indian citizen? No. He is a person of Indian origin, guys. His parents and grandparents are born in India. He is a person of Indian origin, but he is not an Indian citizen. So deemed resident also will not apply. So what's your answer now? Mr. Abhishek is non-resident. So can I say at this stage itself, it can't be option C, because option C has Mr. Abhishek. So I can try saving some time like this in the examination by playing a little street smart over here. It can't be option C also. So even without wasting time on Mr. Joseph, I can say the answer is option A. But still, for the purpose of our clarity, we will still of course think about Mr. Joseph. Let's see what has happened over here. He's an American scientist. He left India to his home country for fixed employment there. He stayed in India for study and research in medicines from 1st Jan 2020 to 1st July 25. So current year, if you see, Mr. Joseph has stayed in India for how many days in the current year? Till July 25. So April, May, June and 1 day in July. So current year, Joseph has stayed in India for how many days? Current year, he has stayed in India for 92 days only. Tell me, guys, which provision will I apply? I will first try special provision. When can I apply special provision? He must be, condition number 1, Indian citizen or person of Indian origin. Condition number 2, he must be visiting India in the previous year. Condition number 3, his total income minus income from foreign sources should be more than 15 lakhs. Tell me, guys, is he an Indian citizen or a person of Indian origin? He is an American scientist. He is not an Indian citizen, not a person of Indian origin. Also, if you see, He is not visiting India. He is not coming to India in the previous year. Instead, he is leaving India in the previous year. Special provision will not apply. I'll come to the regular provision. Basic condition 1. Previous year you must stay in India for at least 182 days. Fulfilled, guys? No. He has stayed in India for only 92 days. Then basic condition 2. I will check. Is he an Indian citizen who is leaving India as a crew member of an Indian ship? No. Is he an Indian citizen leaving India for employment? See, he is leaving India for employment, but he is not an Indian citizen. He is an American scientist. Is he an Indian citizen or person of Indian origin who is visiting India? No. Therefore, I will apply basic condition 2. Previous year you must stay in India for at least 60 days. 4 preceding previous years you must stay in India for at least 365 days. Check, guys. Previous year 60 days? Yes. 4 preceding previous years, what about that? Question is saying from 1st Jan 2020 he is in India only. So 4 preceding previous years, definitely he is in India for 365 days. So here assessee is fulfilling one basic condition. Any basic condition you fulfill, you will become resident. So Mr. Joseph is also a resident. So Mr. Pop and Mr. Joseph, option A. Okay, this was an interesting residential status question. Are you clear? Can I take you to the last question now? Come on, guys, come to one final question. Question number 10. Question number 10 is about section 194T. You know, right? New section applicable May 26 examination onwards only. New section in TDS. 194T. What is 194T about? Very simple section, guys. Partnership firm or LLP is giving interest or salary. The salary you can give any name. You can call this as remuneration. You can call this as commission. You can call it as bonus. Whatever name you want to give, you can give. If partnership firm or LLP is giving interest or salary to partners, on that interest or salary, you will apply section 194T. 194T, do you know what's the limit? If this interest salary is more than how much? There will be TDS. Do you know that? Interest salary, as the case may be, put together should be more than 20,000 rupees, guys. Then there will be TDS at what rate? TDS at the rate of 10%. Okay, guys. Now come on, have a look at the question. A firm pays salary and interest on capital to resident partners. The salary and interest paid fall within the limits in 40B. Which of the following statement is true? Tax has to be deducted under 192. Is it correct, guys? 192 comes into the picture if it is TDS on salary. Salary will come into the picture if there is employer-employee relationship. This salary which we are giving to the partners is an employer-employee relationship, guys. Can I call it typical salary? No. So therefore 192 will not apply. Then tax has to be deducted under 192 on salary. Wrong. Basically section 192 itself will not apply over here. Section 192 will apply if employer is giving salary to employee. Is employer-employee relationship over here? No. Between partnership firm and partners, there is principal-agent relationship. But there is no employer-employee relationship. Therefore, 192 and all will not apply over here. Then no tax has to be deducted on salary, but tax has to be deducted under 194A. See, guys, section 194A does apply on interest other than interest on securities. But in section 194A, it is clearly mentioned that interest to partners, 194A will not apply. So 194A is also wrong. Then tax has to be deducted under 194T. Answer is option D. Okay, and I'll tell you one more thing. One more very interesting thing about 194T. Okay, I'm not sure if you have watched my amendments lecture in YouTube. Then you will know this point already. But I'm not sure if you've watched it. So I'll tell you over here now. When partnership firm is paying interest salary to partners, okay, let's say this amount happens to be 60,000 rupees. But in section 40B, we have limit, right? That interest only 12% is allowed. For salary, we have book profit limit and all. So let's say as per section 40B, even though we have paid 60,000, let's say only 40,000 is allowed. Okay. Now my question to you is, section 194T, TDS will be on which number? Will it be 10% of 60,000, the real number? Or will it be 10% of 40,000, which is actually allowed under section 40B? Do you know this? It will be 10% of the real number, 10% of 60,000. I'll tell you why. Section 40B and section 194T are not connected. Reason is section 194T says amount paid or credited to the partner. Are you noticing the language? They are saying amount paid or credited to the partner. On that we have to compute TDS. So what is the amount paid or credited to the partner? 60,000. So on that we will compute TDS. Whether it is as per 40B or whether it is not as per 40B, that doesn't matter. Understanding everybody? This was your last question, question number 10. Okay, and apart from this, just 4 more adjustments I wanted to discuss with you. I found these adjustments interesting. Incurred loss of 1,17,500 from eligible transaction carried out in respect of trading in derivatives. Derivative trading loss. Can I call this speculative business loss? What do you think? My question to you is this speculative business loss? No guys, this is not going to be speculative business loss. This will be normal business loss. I'll tell you why. When can you use the word speculative business loss? If the question says assessee is doing intraday trading. If the question says assessee is just wants to enjoy fluctuation in price, then you can use the word speculative business loss. Or if the question says assessee is not taking delivery of goods, then you can use the word speculative business loss. But please remember, futures and options, not speculative business loss. Derivatives, not speculative business loss. If the question just says share trading, even share trading is not business loss. Only if it is intraday share trading, then only it will become speculative business loss. Okay, so I just wanted to show you the derivatives is not speculative business loss. Then this I found interesting, okay, because little bit interpretation is involved. The question is saying income from sale of rubber products from rubber plants. My question to you is this income from growing and manufacturing rubber, or is this just pure business income? Income from sale of rubber products from rubber plants. Question says we are first growing rubber plants, then we are making rubber products. This will become growing and manufacturing rubber. Composite income. This will become composite income. Do you remember the numbers? If you grow and manufacture rubber, 35%, 65%. Small number will be business income. Big number will be agricultural income. Okay. Why am I applying composite income over here? Because you are saying we are making rubber products out of rubber plants. So first we are growing rubber plants, then we are manufacturing rubber. Okay. Now listen to the next adjustment. Business of roasting and grinding coffee beans. Here tell me, can I say it is growing, roasting, grinding coffee beans, or will I say this is pure business income? Here the question is saying roasting and grinding. Are we first of all growing the coffee? Are we growing the coffee? No. Only roasting and grinding. Which means we are only doing processing work. We are not cultivating the coffee. We are not doing agriculture. So this 4,50,000 will be fully business income. Are you understanding the interpretation? In the first subdivision over here, sale of rubber products from rubber plants. This indicated to me that we are first cultivating the rubber plant, then we are doing manufacture. So growing and manufacture, composite income it became. But this situation over here, we are not growing the coffee beans. We are only roasting and grinding. We are only doing the processing work. So here there is no agricultural income. Entire amount will become business income. Okay. Then this adjustment, 99,000 pension from employer of deceased wife. Which head of income, tell me? Will it go under IFOS head of income or will it go under salary head of income? Pension from employer of deceased wife. See, assessee retired. Then assessee is getting pension. This will go to which head? Salary head. Okay. Then a person died. After his death, assessee started getting pension. This will go to family pension. Family pension means IFOS head. Are you understanding? Yes, if here wife died, after wife died, assessee is getting pension from employer of deceased wife. This will become family pension and it will go into IFOS head. You know why I'm telling you this? Because when we see pension from employer, what's the first thing that comes to our mind? Oh, from employer, salaries head will come to our head. But please remember, this is from employer of deceased wife. The wife died. After the wife died, the employer is giving pension to my assessee. So after a person died, if assessee is getting pension, that is family pension, it will go into IFOS head. IFOS head, you know pension, what to do. I'll remind you. Normal regime, default regime. In normal regime, 1/3 of the pension or 15,000, whichever is lesser will become your deduction. Whichever is lesser, this is what will become your deduction. Then in default regime, 1/3 of pension which you are receiving or 25,000, whichever is lesser will become your deduction. Then received. You're able to hear me now, right? So just wanted to show you normal regime 15,000, default regime 25,000, then received minus exempt, balance will become taxable. That's it, guys. Alright, so this is it with all the questions I wanted to discuss with you. If you look at the RTPs and the MTPs of your May 26 exam, these 10 questions that I worked out for you were the interesting ones, the difficult ones. The rest of the questions are either already existing questions, which were already existing, we had already seen them somewhere or the other, or they were not tricky. So these were the 10 good ones, and this is what I wanted to do for you, and I'm glad we were able to do them all in this much depth. I'm hoping you all got real kind of clarity. I hope you all had some light bulb moments and some eye-opening moments. Alright, so I'll close over here. Thank you so much, guys. Bye-bye.